Very good morning. You're watching India Market Open. It's towards the end of the week. It's, of course, also the monthly expiry for the Nifty. Global cues are rather muted this morning, but I guess the bigger problem was the monsoon last evening.
Oh dear, for all of them in Mumbai, all of you in Mumbai.
All of us in Mumbai.
Getting home was such a challenge. People were stuck, traffic logging, water logging, jammed traffic, and some of those pictures that came in of streets completely jammed for hours and hours. And people have really, I think, taken in our office 3-4 hours just to get home. And it happens every year, Niraj. That's the sad part in the financial capital.
You know, when people, and either these times when people raise a question about why is it that we're paying taxes, that the question seems justified because this is not done. People in our office took 3.5 hours to get a cab. After getting the cab, 2 hours to reach home. I mean, 5.5 hours to reach because of 1 day of rainfall. Yeah. It's not done.
It's not done.
This is why Mumbai and the spirit of Mumbai gets talked about often.
But
we are back at work this morning.
But Samina, forced spirit. People don't have a choice.
That's true.
It was just awful. It was just awful. There's a red alert issued for today as well. Schools are shut in Mumbai, and we hope that wherever you are safe. If you are in the financial capital, of course. But let's get on to global cues and tell you what the day looked like. It was a bit of a mixed day. For US markets at least, and you saw that winning streak at least broken by the Dow. So the Dow showing weakness. The Nasdaq was okay, but the Nasdaq, because of semiconductor stocks, and one in particular which really worked for tech stocks because of a strong guidance. So you had the semiconductor maker Micron Tech, which was up about 14%. That's why you have the Nasdaq at least in the green. And that was the flavor there. Focus now shifts to jobless claims data, which will come out later tonight. The expectations is that you'll have about 223,000 claims being filed, and this will be important to watch. Remember, personal consumption expenditure data will also be out on Friday, will also be on notice, and which is why you saw bond yields inch up a bit ahead of that key data coming in as well. The 10-year was at 3.78%. Crude prices have actually softened a fair bit, almost 2% overnight. The NYMEX futures now slightly up in the green. Brent at the $73 mark. A bit about the Chinese stimulus which has come in. While Chinese equity markets are very excited about it, crude markets are not, because they're expecting much more to really move the needle on the kind of demand required from China. Libyan inputs are also going to ease, so that will help as well. Having said that, let's pull up what Asia is doing, and Asia at least opened fairly strong, going strong as well. Shanghai up 0.5%. Nikkei, the Bank of Japan, a minute of the meetings were out from their last meeting, and 2.5% on the back of that. Hang Seng up 1.5% as well. Let's pull up the implied open just for a second, because you had a bit of a patchy day yesterday. You're opening up in the green today, 54 points up. Possibly on the Nifty as per the implied open. And I'll quickly go through fund flows as well before we get to the trade setup for the day and the kind of trade we had yesterday. You had foreign investors coming and selling 974 crores, domestic investors close to a little over 1,700 crores in buys, but not massive in terms of volumes is what the big takeaway was, and that's why a pretty range-bound day of trade.
It was, and it was a later surge that saw the markets close above the 26,000 mark that we've been waiting for over the last 3 odd days of trade. Let's quickly recap trade for you, tell you where rollovers stand, because that will give you a sense of Nifty's monthly expiry today, which Niraj will then walk you through. A quick take on how the markets fared. It was a smart recovery in the late hour of trade. Nifty closed at 26,000, up about 0.25%. HDFC Bank, Reliance Industries, Axis Bank witnessed heavy buying towards the last 1 hour or so. Monthly bank expiry also helped the Nifty inch and close above significant levels. Mid-cap index continues to look weak. It snapped a 3-day winning streak, went on with some cuts. The small-cap index has been seeing selling for the last couple of days, so no relief there in terms of trade. The last 500 to 800 odd points on the index have largely come because of what the large cap index and the heavyweights have been doing. The Nifty futures have closed, or rather added 2.5% in open interest by close on Wednesday. Current rollovers on the Nifty 50 stand at 64%, which is a fairly healthy number going into the next series. Nifty bank futures have also seen a healthy rollover figure of 67%, and the futures have added OI to the tune of 23.6%. So the bias very clearly remains that Bank Nifty will outperform the benchmark. The put call ratio is also seen to come in at 1.33, which has been a slight improvement from 1.31. So that's what we have in terms of the performance of the Nifty in yesterday's day of trade. Niraj, like we talked about this is one of those few Septembers where we will be closing the month with very solid gains. And what a relief for Bank Nifty. Till about a month ago, rollovers were well below the 3-month average. Recovery was not coming in, and suddenly they are the star of trade.
You want to say you told people
I said so.
I remember the conversation at the start of the month being September is usually tough. Yeah. And, generally a tough month, but we've sort of bucked that trend. And thanks to Mr. Powell, let's also admit that. In large part.
And a little bit to the Bank of China as well. They came and gave the metals a bit of a shine.
Yeah. Now it's over to
I am just thanking liquid flows, or rather local flows in India, which has kept us up and about.
And well, a little bit of that FI flow that came in Friday's session. I mean, 14,000 crores because of that one rebalance and otherwise, right?
FTSE all-world rebalance, which led to about $1 billion of money coming in the last 2 hours of trade. So that gave that lift. But that was passive.
We welcome all kinds, really, as long as money comes in. But idiosyncratic things happening, right, as we learned through all the conversations in the last few days. But, I mean, you could argue that markets are at heady levels, and caution, if at all, is advised on leverage longs. Where anybody tells you that, you should time the market and take money off the table. People have been talking about this for 2,000 points on the Nifty now, and many more points at the broader end of the spectrum too, and it's not turning out to be right. So very difficult to say that, this is the level from which you should take money off the table. As Pankaj Murarka told us yesterday, it's a bull market. Do not try and overthink what the market will do, because the market will do what it does best. And only Mr. Market knows that. But you should be careful with leverage longs. That certainly is a case, right? And I think I was reading a takeaway of the Daulat Capital conference that they did. And in that, they've mentioned this line, that the pushback they get from people who are bullish is that now the market breadth is so wide that it's very easy to avoid overpriced buckets. You want to bet on manufacturing, unlike 15 years ago, wherein manufacturing was a narrow pocket. There are a clutch of pockets available. You don't need to bet on overpriced defense, overpriced railways, overpriced EMS if you don't want to. You can still buy manufacturing because there's a diverse set of stocks available to bet on, which might be reasonably priced as well. So investors and even large institutional investors have that choice. So that's the other thing to keep an eye out for. Pharma will be under pressure today. Samina is going to talk about it. But just keep in mind that Pharma could be under a bit of pressure today. And just one last point, really, or two last points maybe. One, that, SpiceJet moves shows you, right, that after a point of time, nobody knows too much. At 70, 72, 74, everyone wanted to chase SpiceJet. QIP announcement came in, at stock was at 78. It's back to the QIP pricing, about 20% correction in 7 days.
And yet Carlyle sell a significant stake yesterday.
Yes, and so many noted investors put in the QIP. So people thought that, hey, I mean, investors know.
Where did the money go?
No, they put in at 62, so thankfully it's still not underwater. But after a point of time, you could argue that nobody knows too much. And then the other thing is subscription to IPOs. Manba Finance. Second most subscribed main board IPO, 224
I'm surprised
times.
You still get surprised, Niraj, about these numbers. I mean, we were discussing this, and we have been. You've looked at NSC, you look at what's happening with Swiggy. Tamanna mentioned that our guest test team was intrigued by participating in pre-IPO trades. I mean, that is the amount of euphoria that the markets are going through. But talking about pharmaceutical, that may be on the sell side. What is truly surprising me is the fact that IT is not seeing any low-level buying and making a comeback. There were sporadic trades that happened on IT stocks yesterday. But it doesn't seem like any sort of recovery is on the front. I don't know whether we're waiting for earnings that kicks off in a few days from now, but it just seems surprising that you're not seeing buying despite nearly a 10% correction from its peak now.
Yeah. Could well be, one of the reasons could well be that people are, one, waiting for the US elections to get over.
Yeah.
And I think the Accenture commentary that came out, or not commentary, but their internal memo talks, etc., about how they are delaying promotions, etc.
Pushing their entire pay hike cycle.
Maybe people are a bit
but they're
skeptical.
planning to do that on a permanent basis. I mean, the next 6 months because of softness that they're seeing in dealing pipeline. But I think they're also trying to pair that, saying that, okay, maybe this is a more strategic shift that we will go
So combination of it, plus maybe the US elections. People are just waiting, let that get out of the way because that's such a big market.
Yeah.
Maybe.
I mean, in the first quarter as well, we knew there were elections around the corner. The stock still went up, gained 35%. Let's not forget it. And management was optimistic. One more space, and I don't know very much, but I don't know whether metals may continue their rally today. You have a very good-looking Asian market picture. So from Hong Kong, South Korea, China are all trading with very strong gains. You saw that big move in trade on metal stocks on Tuesday. Wednesday saw some consolidation. I know stocks like Hindustan Copper went into an F&O ban. There's some positive news flow on that stock. You had stocks like JSW Steel, which were on the buy list of a Phillip Capital, but actually sold off. Do you feel like there could be some buying and metals could become a good space to trade on today? Yeah. Only because the fact hasn't changed that there is liquidity now.
Yeah, and some bit of measures by China for sure, even if
and
they
some
might
more
be
coming is what we believe.
From what they have said. But yeah, I mean...
So metals could once again be a
2
good
days of
place.
gains, right? Let's see if there's
Yesterday, Niraj, I think, was muted. Tata Steel was okay. It built on its gains. JSW was negative. Hindustan Copper had it quiet. Nalco didn't do too much. Now, whether they resume the rally is something that traders will want to watch out very closely in today's day of trade. Well, that's, of course, in terms of stocks, but I'll talk about one more counter in the metals pack that will be in focus for the right reasons this morning, and that's Vedanta. Apart from everything that's happening on the macro level with metals, we believe the company's board is going to meet on the 8th of October. They are looking to consider a fourth interim dividend on the 8th of October at this meet. The record date will be set as 16th of October. This is big news. It's usually stock moving. The stock went home gains. This is one of the metal gainers in trade yesterday. Largely could be on back of that. You could see some more activity on Vedanta in trade today. Well, along with Vedanta, a few more, and it's the season of raising money, selling stake, and that's largely the theme. 5-Star is one company you want to track. The holders are looking to offload a very large, significant stake in the company to the tune of 19.2%. The worth of this is going to be 4,317 crores. Now, this is via a block deal. It's a large block deal. What we've seen is there are companies who've been coming in, reducing the stake, but they're using the slicing method, which is popularly seen in the space where promoters in small proportion offload their stake. But this one, of course, going all out, 19.2% stake being offloaded by its promoters. The deal is valued at 4,316 crores and has a lock-in period of 12 months for selling shareholders. So this is a counter you want to track. Stock was up 5% yesterday. Not sure how the reaction is going to be in today's trade. Volumes also were rather significant at $7.4 million, 7.4. So a big block likely on 5-Star is what we have. Pharma companies, Niraj has alluded to that, will have a rough this morning. The reason being it's a CDSCO, which has flagged 53 drugs samples are failing to meet quality standards. Some of these drugs are popular drugs that people like you and me use pretty much regularly in that sense. It's drugs like Pantocid, calcium and vitamin D tablets, paracetamol. The companies that are involved in selling these drugs are the likes of Sun Pharma, Glenmark, and Alchem Health Sciences. The proportion of sales that comes or revenues that comes from these drugs ranges anywhere between 5 to 10%. So big impact, even though the companies have responded saying that these were counterfeit drugs that were not produced by them, but sentimentally definitely a negative. And more importantly, if these are counterfeit drugs being sold at pharmacies, how do individuals like you and me avoid buying this?
No, and
this can't be right.
And I find it astonishing that companies can come and say counterfeit drugs mimicking their own brands out there is not really, in a sense, what they're trying to say is not my problem. right? It's the regulators, the market, etc. But I think this is definitely perhaps going to be a sentimental downturn for some of those pharma companies today.
Hopefully not just sentimental, because this is big. I mean, Pantocid. I mean, I don't take too many medicines, but
Pantocid is one of them.
But Pantocid,
I've heard so many people. Take, right?
Yeah, that I do once every week. But yes, I mean, Pantocid, I've heard so many people take, right?
Yeah. It's astonishing if we have that kind of a situation happening. That's really, really scary. All right. More stocks on the list?
I think that's what I have.
Okay, all right. Let's go to some of the other ones that we're talking about today. Uno Minda is one that I'm tracking. So this is definitely a positive for the stock. Their arm is in fact with Korea-based Hyundai Mobis. They will make things like speakers for them. So they will be licensing products. The announcement, but remember, it comes a day after the Hyundai India IPO has got its nod. So a lot of excitement there. Some of that positive sentiment could hit Uno Minda. Remember, they've had a pretty good set of responses as well coming in, and news pieces coming in the last few days, including a 600 odd crore investment that they're making in Indonesia. So that's one to look at. Zentech. Now, this is an interesting one because of the sort of cutting edge technological stuff they do in the defense space. They have launched a remote controlled weapon and surveillance system, and this will strengthen India's defense capabilities. As is with a lot of these defense pacts, not too many details are available for obvious reasons, but Zentech could see a bit of an upside thanks to it. Ease My Trip is the other one, and I think everyone has a lot to say about this deal that we have seen. So the promoter, Nishant Pitti, has finally sold 13.91% stake at an average price of 37 rupees and 64 paise. He held a 28.13% stake as of June 2024. Who's bought? Core for Marcom bought 2.82 at 37.95. Kraft Emerging Fund bought 0.59%. The stock was hammered yesterday, maybe in part because there was so much of uncertainty and confusion about how much promoter stake is being sold. We started with a figure of 8% being reported, then 10%. Eventually, they've offloaded 13%. It's something, I don't know, you guys weigh in. It's something that the street doesn't like if the promoter is offloading, and that too more than what is anticipated. And that becomes a bit of a concern.
It should be a concern because you'd imagine that makes you believe that the promoters feel like the stocks are well priced in that sense. But talking about that, Tamanna, in fact, it's not just, we only look at the big ones, right? The big block deals that happen. But I met a few people yesterday and they said that there are many, many significant promoters who may not be running the business in their natural capacity, but are offloading stake. They're doing it in small portions without disturbing the market dynamic or the stock price, and that has never happened. It's at a historical record high in that sense. So yes, it's a worry, but the market doesn't want to view it as a worry for now.
Yeah, but for on Ease My Trip, the market certainly viewed it as a big worry because 16% down. I think we were talking about it on the closing show yesterday. And maybe there is a valid reason. Maybe the promoters need to give out what the valid reason is. But they've sold 10% stake in FY24. They've sold 13.9% in yesterday's session. That's cumulative 24% stake sale in about 18 months.
Yeah.
For a business which is talking about foraying into EVs, etc., etc. So presumably the growth numbers are very high. Why such a large stake sale?
Yeah.
I repeat, maybe there's a valid reason. Let the promoters come out and say so.
Yeah, we invite
but this is large.
The Pitti brothers to come and speak to us here on NDTV Profit. But I think that's definitely a fair question. That if you're going to expand your business, why are you selling stake?
And at such a large number.
In such a large number,
why did we not see that on 5-star? There was a sense that there was going to be a 19% block deal today. The stock went home with gains of 5% yesterday.
Yeah, yesterday Goldman, etc., maybe bought it as well in the block deals, but it could be interesting to see if this 19.2% stake today has a bit of an impact.
If that's the logic, if you're going by, then I think a 19% stake is very significant in that sense. Yeah. But yeah, I guess other stocks too. We've also got ASK Automotive.
Yeah, so those two block deals, very quickly, I mean, watch out for 5-star, as Samina said. Holders look to offload about 19.2% stake via block deal at 768. A large block deal. Now we know what happens to maybe large block deals, so watch out for that. And ASK Automotive, promoted to sell about 6% stake via the OFS. I think the floor price is set at 433 per share, so do watch out for that as well. So these are the two in which there is going to be a block deal today, and therefore you want to watch out for that. But Tamanna, sorry, any other stock pending on your list?
No, I think just PB Fintech is one we should mention, if at all.
Yeah. No, please finish your list and then I'll come in my three.
PB Fintech, actually, only I found it interesting because the company has come out with a clarification that they're not foraying into the healthcare space. But I think that's going to excite people more because it's going to put on the radar that this is definitely something they thought of. They said no clear plans now. This is actually Ashid Dahiya in their call saying that it's an allied system, right, for people who are buying health insurance. Let's also look at hospitals. Let's also look at an extension. And then they come out and clarify saying that nothing right now.
Yeah.
But I think it might have the reverse effect and maybe might add some excitement.
Yeah, so should watch out for that. Okay, very quickly, just so two stocks on my radar. One of them is Adani Green, and standard disclosure for Adani Group own NDTV. But promoter group entities, two promoter group entities acquired cumulatively about 2.96% stake in the company. The stock has had a good run recently. Could be interesting one to watch out for. And from clutch of brokerage notes out there yesterday, or rather this morning. But I thought the City on Trent was interesting in addition to UBS on Hero. UBS on Hero we'll talk about, but the City on Trent is the interesting one on my list today. The stock has had a good run. They've initiated the coverage at buy rating with the target price of 9,250. At those levels, City Trent trades literally at egregious valuations, but City is saying that the 20% valuation premiums are justified given the strong revenue and EBITDA CAGRs of 41 and 44% of the company. I think those numbers of 41 and 44% EBITDA CAGRs are important. And they believe there is a higher revenue CAGR versus India's leading listed retail companies and for Trent. So that is to be watched out for. The pecking order as Trent, Devyani, Kalyan Jewellers, etc. But Trent right up there. Let's see if there is a bit of an uptick today. The expectation, guys, was just before I wrap up, was that because it's entering the indices, there will be some inflows until September 27th and then cool off. We saw a bit of a cool off yesterday. Let's see if the City note excites Trent yet again today.
If it's missing any excitement, that is. But just one more stock, and I alluded to Hindustan Copper a minute ago. The news this morning is that the company has approved sale of its unit, which is a copper ore tailing plant in Madhya Pradesh. The reason I highlight this is because just the day before yesterday, Hindustan Copper saw significant rise in volumes. They also moved into the F&O ban as the segment exceeded the 95% of market-wide position. So the markets may have had a whiff of this development. The stock was rather muted in trade, but this is a big development. So in the cash market, you will see activity on Hindustan Copper, though upside could be capped because it remains in the F&O space. It remains in the F&O ban space. Okay,
the big story we're focusing on this morning is definitely what is going to be the focus in the pharma sector. Now, what is the impact really of the action that the CDCO, that's the Central Drug Control Agency, has taken? They flagged 53 drugs for quality failures. My colleague Varsha is joining in on more of these and more details. Varsha, which are the companies that could be impacted? That's the big question, isn't it?
Yes, Tamanna. So, big pharmaceutical companies like Sun Pharma, Alchem Lab, Torrent Pharmaceuticals, Glenmark Pharma, these all companies are involved because these companies make these products. So, as we all know that the Indian regulatory has flagged 53 drug samples for failing to meet the quality standards. And among the drugs on the list are we use on a day-to-day basis, like Pantocid, then paracetamol tablets, and calcium and vitamin D tablets. Now, the CDCSCO has released two lists detailing the drugs that failed quality tests. The first includes 48 well-known drugs, and the second list features 5 more items. And in response, actually, several manufacturers like Sun Pharma and Alchem Lab have disputed the filings, claiming that the flagged batches are counterfeit and not produced by them. And this incident comes after the Indian government recently banned 156 fixed dosage combination drugs over safety concerns. These includes antibiotics, painkillers, and multivitamins. Now, coming to which all companies will be impacted. So, let's see how much of this drugs contributed to their numbers. So, starting out with Torrent Pharma, the name of the drug which has been flagged out as Shelcal, which contributes almost 10% to their Q1 FY25 numbers. And so, this drug almost grew 17% year on year for Torrent Pharma, and they are expecting double-digit growth for this product. Then we have Pandi, which is manufactured by Alchem Labs, contributed almost 4.4% to to their FY24 sales. Then Sun Pharma, which manufactures Pantocid, contributed almost 5.9% to FY24 numbers. And lastly, we have Glenmark Pharma, which makes a product called Telma. So Telma is a mother brand which has 16 brands under Glenmark Pharmaceuticals, which contributed almost 8.7% to their FY24 numbers.
All right. Varsha, Varsha, just one small clarification. Maybe you gave it already. But in Glenmark's case, because the graphics lay it out that way, Telma, which is the drug implicated, has I believe, 16 drugs, right? And one of them is under question. So the impact of 8.7% for Telma may not be as telling if Glenmark cannot sell this drug because it's problematic, because the others are still okay to go.
Correct, Niraj. Yes, you're right.
Okay. So, viewers, remember, a lot of drugs from a lot of companies, and this is a big consumer story as we discussed as well, in the unlisted space too, by the way, which are getting implicated. On the listed side, these are the 3 or 4 names that Varsha has laid out with those numbers, which is become very important. So, remember, we spoke about it in the morning. Samina highlighted that. Varsha laying it out for us. Watch out for pharma. Could be a big pocket to monitor today. But I dare say, Samina, the bigger pocket to watch out for is what's happening in the primary markets. And I agree, I shouldn't be surprised, but I still get surprised at 225 times, 230 times subscription. What to do? Maybe I'm a conservative guy.
It's not a pocket, it's a whole suit. Manba Finance, again, exceptional response. 224 times oversubscription is what we saw on the subscription. Now, what is Manba Finance? You're probably wondering, and I attribute the success of the excitement around this subscription to what happened with Bajaj Housing Finance. A feeling of FOMO, a feeling of getting into the NBFC space, and guess what? Manba Finance gets a great response. Just to quickly recap what they were trying to do, it's a very small IPO, about 150 odd crores. They raised about 45 crores from anchor investors. No major marquee names came in on Manba Finance in the anchor investment round. Chartered Finance and Leasing was their biggest anchor investor, who invested about 10 crores from the 45 crores that came in from the anchor book. Funds are going to be used to augment their capital base as expected. They provide salaried and self-employed individuals for 2-wheelers and 3-wheeler loans, for new vehicles, and for, of course, second-hand vehicles. They also do personal loans. The numbers were pretty solid, but what you want to keep in mind, well, the yield stands at 21%. It may or may not be sustainable for Manba Finance. Also, what's worth noting is the big jump that we saw in revenues came in on back of a write back that happened on an asset for the company. So yes, there is excitement, there is liquidity available, and hence the money is going into these IPOs. But Manba Finance is a good story, but is it a great story to be subscribed 220 times? Is at least not what the anchor investors had thought, because you only had a bunch of small anchor investors who came into this one. Well, that is about Manba Finance. Let's move on from what opens today now. It's Diffusion Engineers. Interesting name, interesting business. Most people won't even sort of understand what it does, but let me try and walk you through what this one is about. Subscription opens today, closes on the 30th of September. Again, not a very big issue. It's about 158 crores. The issue price is the range of 159 to 168 per piece. At 168 rupees, the market cap of the company comes in about, the total comes in about 700 odd crores. Well, what you want to remember is what are they going to do with this money, right? So very important to identify where that money that they're raising is going to be spent. They will be funding capital expenditure requirements going ahead towards expanding facilities. They already have 4 facilities. They may look at getting on some more facilities with the money that they're raising, and the rest of it would be used for working capital requirements. Now, what does Diffusion Engineers do? Like I said, it's an interesting business, maybe difficult to comprehend, but let's try and see and understand what the company really does. They provide a super conditioning process at its 4 manufacturing facilities. In and around, a couple of them are in Nagpur. It provides surface treatment solutions for machine components that enhance wear resistance, eliminate stress, and improve repairability and sustainability of machines. So the job or their revenue really comes in from clients who are looking at OPEX. So it's not about new facilities coming on board, but for healthy maintenance of existing machinery is the kind of work that Diffusion Engineers provides. Numbers were good. Revenues were up about 9%, so not massive, but a good healthy growth YOY. Profits saw a big jump. That jumped about 39%. Margins also improved significantly. Profits came in at about 30.8 crores. Now, why should you be concerned, or what should you keep in mind? 90% of Diffusion Engineers' business comes from Indian clients, which means they do very little exports. Any changes in the domestic market could impact them significantly because their revenue book is not very diversified. They also have some years when we've seen negative cash flow for the company. Those could be in down periods in the industry, and that has been visible. But remember, if you're a listed entity, you want to try and maintain a sustainable, predictable cash flow in that sense. So that's the other factor to keep in mind. And like we said, it's a high working capital business. So they time and again require working capital, which is fairly large. Some part of the fundraise that they're doing through the IPO will be used to be kept aside for working capital, and they'll also retire some debt. All that together should garner well for Diffusion Engineers. But Tamanna, Niraj, I don't think this one is going to get the sort of response Manba Finance has seen.
Never know.
That's true. You never know.
You never know. I think it's all a matter of timing.
But I have a trivia. So Manba Finance on day one was subscribed 24 times. KRN Heat has been subscribed 24 times, day one. If KRN Heat reaches 73 on day two, which is what Manba did on day two, then I'm bracing myself for 225 times on KRN on day three as well.
Oh, so you're tracking it like a technical analyst?
Like a technical analyst, exactly.
Resistance break kar diya IPO subscription ka.
So subscription upar ho jayega.
I mean, I don't know, as
that's
much,
silly. I'm just
as exciting,
joking.
As exciting as this is, it's always with a bit of trepidation when there is just too much excitement in a primary issue. And talking about excitement in primary issues, I think nothing can beat the excitement about NSE. If you're thinking Manba is exciting, you ain't seen nothing yet as far as the NSE IPO is concerned.
The number of times will not be that large, I would reckon, on NSE.
Excitement. The parameter
excitement,
is
most
excitement.
certainly, yeah.
I think NSE is responsible for all this. No, because you are early investors who got in.
Yeah.
They've tripled their money. Of course, they've also had to wait because NSE's had so many problems around the listing and the filing and regulation. Then you had all these small IPOs coming in, and you're thinking the best way to make money is to go out and pick up an IPO, and hence everyone is enjoying their fate thanks to NSE.
Well, I'll tell you what, somebody sent me this message of his tweet that this is my response to anybody who flaunts the NSE shareholding, and that was the 5-year share price move of Bombay Stock Exchange. And I don't know if you can pull it up, but if you can just pull up the 5-year share price move of the Bombay Stock Exchange stock, that shows you that no matter what NSE would have done, BSE has just taken it to the cleaners. Look at that, 5 years, BSE has gained how much? Sorry, the number, 1,900%.
Most of it coming in the last 2 years.
Doesn't matter. But
most of it, it's 2023 story honors. But
go on.
No, because Agam is standing by and he's got that comparison between NSE
but
and
just
BSE.
Before we go into that, and I want to take a cue from what happened with NSE, BSE, in some form a duopoly. We're seeing that on Swiggy and Zomato.
Correct.
So people who are going through a fear of missing out on Swiggy have and should be mindful that look at what has happened to Zomato in the last few months.
Yeah.
It's not done 1,000% because the time span is shorter. So anyone who's feeling bad that they've not got their hands on Swiggy because it's at a deep discount and it's a great opportunity should just, and I'm not recommending this, but if that's what you're thinking, talk to your advisor. Maybe playing Zomato is not such a bad idea even at these levels.
Yeah, but the fact is that a lot of people have already had that idea. So definitely check with your advisor. Coming back to NSE and BSE. Exciting news yesterday because of a Wire report on the kind of valuations NSE could see. Isn't it? Doesn't it start from there?
Tamanna, I'm going to take a cue from exactly what Niraj pointed out right now. We're seeing NSE's valuations behind the charts moving up, but just look at the way BSE has has moved up. Now, it's a little bit of a chicken and egg situation as far as investors are concerned, because it's really uncertain right now whether or not BSE is driving valuations for NSE or NSE is driving valuations for BSE. And it is a little bit of a question mark given the kind of demand that we've seen for both these equity stock exchanges. But, I'm going to start off with just the basics. So yesterday we had a news report which suggested that NSE is now going to be valued twice as much as what it was a few months ago, at around $36 billion. That comes to roughly 3 lakh crore rupees. Now, 1.5 lakh crore rupees was large enough, but at 3 lakh, it is substantially higher. And yet, when you look at the operating metrics for NSE, you will notice that that could perhaps still be at a significant discount to what BSE is going at. So let's start by taking a look at some of your metrics. So we start off with revenue. On a CAGR basis over the last 3 years, it's head on. They're both shoulder to shoulder for NSE as well as BSE, nearly 40%. But over the last 1 year, BSE has seen its revenue move up around 71%. And of course, that's also largely on account of an introduction of a lot of businesses and reintroduction of the futures and options space, which is meaningfully contributing now to the top line as well. Coming down to the operating metrics as well, your operating margins. While NSE's operating gains have not seen as much growth, BSE has seen a staggering 100%. And based on that, still look at the absolute EBITDA margin for the NSE. That stands at over 2 times as compared to BSE. So once again, while NSE does not have an advantage in terms of growth for its operating gains, it has a significant advantage when it comes to your overall absolute operating margins coming in. Now coming down to the valuation metric. At the moment, if you just consider NSE at around 3 lakh crore rupees against BSE's 51,500 odd crore rupees, if you just consider the market value to sales, that's one operating metric that you can consider. For NSE, that stands at around 20 times. And for BSE, it stands at around 37 times. And remember, this is after I have doubled NSE's value. It still goes at a significant discount to BSE. And of course, price to earnings valuations. I know this is trailing. So, this number could look very, very large for BSE. But even if you double your BSE's profitability, that would still come in at around 60, 70 times, and that would still be higher than NSE if you just compare maybe a 20% growth on the bottom line. Hence, the market at the moment still feels that NSE could not just be valued at 3 lakh crore rupees or $36 billion, but it could be even higher simply because of the fact that it is going at such a sharp discount to BSE in this case.
It's also the unlisted versus listed, the same logic. I know I keep coming back to this, but also at a deep discount to Zomato, and that's why the excitement around these IPOs. But Agam, don't go anywhere. We've got the monthly Nifty expiry. Rollovers have looked healthy at about 68% on the Nifty 50. I know you and me talked about this, and we said, we'd probably hit 26,000 on expiry day.
Yeah.
It did it before we thought so. So what are we looking at today? New highs, likely again?
Most likely, but it's a wait and watch on that one. But 26,000 is now out of the picture. So we're going to keep an eye on, 27,000. Maybe, maybe not. But let's take a look at how things are faring, because it is, of course, the futures expiry. So we're just going to keep an eye on rollovers. But given the kind of strength that we've seen over the past few days, the rollovers have been towards the long side. And rollovers have also picked up quite a bit yesterday. And today, if we do see the number move around the mark of 70, 75%, a lot of that will be towards the long side, most potentially. And this also means that traders at the moment are betting on a slightly higher up move as far as the NFT is concerned in the month of October. The Bank Nifty, we're already looking at a new series, so rollovers won't be relevant here. But sure enough, your open interest has increased around 26%, but this is early days, even as the index moves higher, and that also continues to trade at, life highs or near life highs. But moving on to the options market, and today is a day where we do see a lot of traction around the 26,000 mark. So as Samina was mentioning, 26,000 call is where we do have a significant amount of open interest. And 25,900 puts. So it's a 100-point range within which could potentially act as a fulcrum for the Nifty today. And should we see consolidation, there's most likely we will see the Nifty close around 26,000, but you never know, because over the past perhaps 7 or 8 weekly options expiries for the Nifty, it has been extremely volatile on an intraday basis, very, very choppy, and option premiums are always anyways considerably contracted. So that's the other thing that you need to keep in mind. And of course, we'll be seeing a lot of unwinding as far as stocks are concerned. But in general, we are looking at an up move when it comes to Alkem Labs, Nalco, to a certain extent, Eicher Motors, though a marginal one out there. And besides that, long unwinding in United Spirits or HDFC AMC is a marginal cut, so won't be talking too much about that. That said, let's take a look at what our experts have to make of the current markets and how they are placing their bets. Well, for today, we have Rahul Ghosh of Hedge.in, who's joining us on the show. Rahul, good morning. Thanks for joining in. Your view now, what's your assessment and how are you playing these markets?
Good morning and thank you for having me. So last week around, we had planned a bullish trade on Bank Nifty because our view was Bank Nifty up to 26 September and similar to your view would stay bullish, and that view has played out. Currently, we don't expect Nifty to touch 27,000 in October series. Now, I've said this before, October is a 5-week series, and whenever we've had a 5-week series, if you check the data for the last, I believe, 12 years, you will come to understand that 5-week expiries have both-sided movements on the index. That is, you see a sharp up move as well as you see a sharp down move. So although we might see Nifty go up, you can be a little assured that Nifty would come down below 26,000 as well in the series. We don't expect Nifty to touch 27,000 in October. On the Bank Nifty front, we actually expect some tepidness in Bank Nifty. But not for the immediate 3rd October week. We are playing it for the 9th October series. And of course, I can go ahead and explain that structure to you as well.
Please go ahead and explain how you are placing option bets on the Bank Nifty now.
Sure. So what we're doing is we're using the 9th October expiry, which is 1 week from now. And we're buying the 53,500 put option of 9th October expiry at the current market price. We're selling 2 lots of the 53,200 put option to basically cover the debit of the 53,500 put. And we're again buying the 53,100 put option. Now, this trade would make you money if Bank Nifty was to move down. This trade would not lose you money if Bank Nifty stays sideways. And if Bank Nifty goes up, which is contrary to our view on or before 9th of October, then this trade would face a loss of about 1,000 to 1,200 rupees totally with respect to this.
All right, Rahul, and any other considerations or perhaps adjustments that you need to make, or do you want to continue to ride this until, or rather near the expiration of these contracts?
So the capital required in this trade is fairly low. And I would suggest if you're making about 2 to 3% in the next 10, 12 days, it would definitely prove to be a good return on the strategy. I don't suggest any modifications for this because if you notice, all the 3 expiries on all the 3 legs are of 9th October itself, so not really required for any modification. I would suggest this trade can be entered as long as Bank Nifty stays between 53,700 and 54,500, which is going to be the opening today, which was the closing yesterday as well. So enough room for people to enter the position as well.
All right. Well, Rahul, we leave it at that. Thank you so much for joining us and taking us through your views on the markets and, of course, giving us that, option structure to work with when it comes to the Bank Nifty. Do remember that we're also taking up your futures and options queries on our show today at 10:30 in the F&O show. And if you do need an opinion on, well, perhaps a position that you're thinking to take on or you already have one, don't forget to WhatsApp your particular call or put option, or for that matter, futures on that WhatsApp number which is being flashed to you on your screen. We will be keeping an eye on that, and we will most certainly be taking your queries there as well. With that, it's back to you all.
All right. Thank you for that, Agam. I think one stock which is definitely going to be in focus today is Hero. Hero Motor, because UBS has maintained a sell rating on the auto major with a target price which is 44% down from its current market price. What's concerning UBS when it comes to Hero? Harsh is joining us with the details.
Well, just as a backdrop, we saw the Hero stock price go up and go up quite sharply. And what UBS is suggesting is that sharp increase in stock price was largely driven by wholesale volumes on the one side and also strong management commentary with regard to the festive season on the other. Now, what they are saying to this or countering to the way in which the market has treated Hero is, one, they're looking at inventory trends and suggesting that inventory buildup is very, very solid, and therefore likely the festive season is already getting built into the inventory. In fact, they believe that given the intense competition with Honda, Hero may actually have to give discounts. Honda may too, but Hero may actually have to give discounts, and therefore they may actually see an overall muted number when it comes to revenue with regard to the festive season. Second, what they're saying is the festive numbers over the last 2 years in terms of volumes have been strong, but they've not impacted overall FY or full financial year volumes. In fact, full financial year volumes for FY23 were just 11% and 6% for FY24, which is far lower than the industry when you're looking at the full year volumes. And therefore, coming to the market share piece of it, they're suggesting that market share has actually fallen now below the 24% for Hero, in fact at its lowest point before the start of this festive season. That's where they believe the concern is, and now Hero is 400 basis points below Honda when it comes to market share. This, they believe, is a significant erosion also caused by scooters and EVs, which is the trend currently in small towns. And therefore, they believe the market is already pricing in a large part of the recovery in commuter motorcycles, much more than what actually will translate this festive season. They believe that the stock, which is trading at 26 times FY26 price to earnings, is more than 3 standard deviations higher than its 5-year historical average, which is much, much higher in simpler terms than its 5-year average, which is why they've given it a 45% downside from here, 3350 being the target price.
It's going to be a tough day for auto anyway, and Hero MotoCorp is probably going to be on the sell side on back of UBS's sell report. But lots of other stocks that you want to watch out for this morning. 5-star, well, the holders are looking to sell 19.2% stake in the company. A big block is expected. The stock went home with gains yesterday. Will be one to track this morning. There's a good chance while it's on your up list, there could be a negative movement on the counter. Zentech, that's a big one again, and they've been on the spree. This time around, new weapon surveillance system has been developed by Zentech. If you were missing action on Trent, it's been a few days. It's been a minute. Citi initiates another buy report on Trent with an upside target of 22%. Uno Minda has signed a pact with Hyundai Mobis and GBM Auto Singapore unit to carry on EV biz.
All right, some other stocks that are in focus, and this is on the downside, is of course Hero Motor. We spoke about it in some detail. UBS note, which is seeing a 45% downside, is bound to hurt the stock, at least in the first half of the day. ASK Auto promoter is selling up to 6% via an OFS. Generally, the street doesn't love it when the promoters try to cash out, so to speak. Pharma companies, keep that in focus definitely because of the regulator finding 53 drug samples failing to meet quality standards. This would include a Sun, a Torrent, and players like those. It'd be a bit of a hit over there as well. Easy Trip Planners, the promoter has sold more than what the street was anticipating. That could be seen as a downside today. All right, let's start the conversation. Shrikant Chauhan and Niraj Shah joining us on the show this morning. Very good morning to both of you, and great to have you on as always. Shrikant, let me start with you on, Nifty expiry day. Where do you see the indices going?
Good morning, Tamanna. Good morning, Samina, and everyone. I think, this particular market is following the trend of higher top, higher bottom, and whenever there is a correction in the market, we are seeing buying interest. This time also on Wednesday, when there was intraday correction, we saw specific buying interest at 25,800 levels. Even if we go through with the option statistics, then there also we saw gradual shift from the levels of 25,500 to 25,800. So 25,800 is now going to act as major support for the day. On the high side, 26,100, 150 is going to make a major resistance for bulls, because there we are seeing good amount of call writing, and in case if we see the Nifty sustaining comfortably above the levels of 26,100 in the second half, then the chances of hitting 26,500 in next few days would turn bright. Broadly, I'm of the view that the markets are like doing well. Bank Nifty is also supporting, Nifty Metal Index is also contributing, and Nifty IT Index is also available at important support levels. So broadly, I think the markets are okay, but it is advisable to buy if there is any correction. If we go through with stock-specific ideas, then I think we should look for adding those companies or those stocks which are very close to their support levels, or they are into specific breakout. TCS is one of that. It is very close to its important support levels of 4,200. From here, again, the stock can attempt the levels of 4,500 in next few days. It will take some time, so it's a positional buy. But buy at current levels with a stop loss close to 4,190, we can expect 4,500 on the higher side. And the other stock which we like is from the metal basket, and that is Hindalco, which is currently trading around some 720, 715. It's a buy at current levels with a stop loss at 700. And again, the stock can move to the levels of 750, 55 in next few days.
Okay, so those were the top picks as far as Shrikant Chauhan is concerned. Shrikant, what about the Bank Nifty specifically? What is the trade on the Bank Nifty today?
Yeah, I think like Bank Nifty is also indicating similar sort of activity. There also 54,300 going to act as immediate resistance, which is corresponding to the levels of 26,100 on the Nifty. But crossing this 54,300 would lift Bank Nifty towards 54,600. So which is the ultimate target that we are seeing in the near term for Bank Nifty. So 54,500, 600 is the area where we should look for taking some profit on Bank Nifty, and 26,100 to 150 on Nifty. I think these are the levels where we need to be a little bit careful.
Okay. Well, some trading ideas for our viewers today. Now, let's talk about some fundamental names. I want to start off with a stock that was in news yesterday, Niraj Shah. Is My Trip has been the talking point, was down about 16%. A lot of people might get enthused. Itna gir gaya, let's go out and buy. But the promoters have sold 24% stake in the last 18 months. What is your calling here? Are you enthused by the space that it is in? Or would you prefer other players and not Is My Trip?
Yeah, good morning and thank you for having me on your show. Yes, as you rightly pointed out, that it's very tempting when a stock falls to such an extent, and most of the investors tend to get lured away by such corrections, such deep corrections in the stock. But it's very important to understand the quality of the management, what is the intent of the management, and particularly in this particular case, it's a very interesting space to be in. But I think the action of the promoters to liquidate such a big stake, I think does not inspire confidence, at least as far as we are concerned. So it would be better to stay away from the stock.
Other one which has fallen quite a bit, I'm talking about the losers right now, Nirav, is SpiceJet, right? 78, then the QIP news, the stock has corrected 20%. Would you avoid it? Is Interglobe Aviation a far better player to bet on, more stable, etc.? Because, it's like a template of what happened to Vodafone versus what happened to Airtel, right? A large stable player versus somebody which is trying to make a mark, struggling a little bit here and there, has gotten the money. But it's not that Vodafone got the money, but the stock didn't go anywhere to an extent and has come off. What would you do with the SpiceJet versus an Interglobe?
So both the stocks which you have mentioned over here, they are both very tricky cases. For example, in the case of Vodafone, we have a set of good news as well as bad news coming in every now and then. So I think coming to SpiceJet, I think it would be better to stay away from the stock because there's been a sharp fall, and I think the operational parameters are still not inspiring confidence. So I think we would stay away from SpiceJet at this point of time. And Interglobe is looking quite expensive at this point of time. So broadly would like to avoid this sector overall.
What are you doing with some of those banks today? HDFC Bank, Axis saw some activity in trade yesterday. ICICI Bank was lagging slightly behind. Amongst the three banks I named in the private sector, any fresh long trades?
I think, see, Axis Bank is quite attractive at these levels. It is holding in the range of 1260, 1265 on the higher side and 1230, 1235 on the downside. On Wednesday, we saw higher closing for the stock, and based on its formation, I think the stock is heading for at least 1330 in the near term. But if we consider next few weeks or months, then it is heading for the levels of at least 1450 or 1500. So certainly it's a buy even at current levels. If there is a medium to long-term view, then we should look for adding even at current levels. But if there is a position trading view, then we have to keep a stop loss somewhere close to 1200 for adding this particular stock. But HDFC Bank is now very close to its resistance level, and the formation is indicating us that it is heading higher, but very close to resistance level. That's the reason it is advisable to buy if there is any correction. For ICICI Bank, there also we feel the same thing, that it is very close to the resistance level, and it is advisable if it correct back to the levels of at least 1280, 1275.
Okay. We'll take a very short break, but when we come back, we're talking about Hero. We're asking our experts what you expect to do and what really is the play for the day. We're coming right back. Stay tuned for more.
Back with India Market Open right here on NDTV Profit. About 2.5 minutes left for the markets to kickstart trade. But a clutch of things that can be focused on and should be focused on, if you will. Shrikant, we've seen some very strong moves in metals already. So let's choose one. Let's say Vedanta, because that's got a fundamental trigger as well, because there is another meeting for a dividend. It's had a bit of a rally. Can there be more here? What are the levels that you would watch out for?
Yeah, Niraj. I think, this particular stock, it's showing a greater strength, in fact. If we consider its overall trend of last at least 12 months, then it was somewhere close to 200, 250 levels. From there all the way without any major hurdle. It touched the levels of 500. And after that, for almost last 4 months, if you see the entire technical pattern of it, then it was consolidating. And now it is comfortably and confidently crossing the resistance mark of 480, which is something really positive for the stock. Based on its technical formation, I am of the view that the stock is heading for at least 520, 540 in next few weeks or few months. It will take some time, but even at current levels, if we consider the returns, then it is close to 10 to 15% from current levels. And if in case if there is any correction, then the downside is quite limited. Close to 450, 460, the stock is having excellent support. So I'm of the view that even at current level, it's a buy with a target of at least 520, 530.
What's the loop on metals? There's also some news on Hindustan Copper, but it's in the F&O ban. The stocks had a good run for the last few days. JSW Steel, which was on the buy list of Phillip Capital, but the stock hasn't responded too well despite the whole sector doing exceptionally well. And Tata Steel, because that seems to be in a winning streak for the last 3 days. To add to Vedanta, 3 more stocks for you. Technically, which one looks good?
See, like JSW Steel will remain under some pressure because it's a core player of steel. And if whenever there is a rise in the iron ore prices, we see some upside pressure. I'm going to say some profit-taking pressure on JSW Steel as well as Jindal Steel and Power because they are core players. But those which are like having capacities of iron ore, they do well. And in that space, Tata Steel looks really good. I think it is heading for the levels of 175, Tata Steel. And if we consider the other stock like maybe Steel Authority, I think there also we can see some activity. But Hindalco is also one of the strongest candidate from the metal space, which can do really well in next maybe couple of days. It is above its important resistance level of 710. From here, the stock can move to the levels of at least 780 or 800 in next some few days or weeks. So it's a buy.
Okay, let's just talk a bit about PB Fintech. First, pre-open rates are opening. We'll wait for them to settle. But Bernstein, talking about PB Fintech, and we mentioned this in our trade setup this morning as well, that the fact that they have come out and said that no plans right now has also highlighted the fact that they're even thinking about it. And Bernstein is on the same lines. So what am I talking about? Bernstein has maintained an outperform with a target price of 1,720. The stock price is already above that, 1.5% up in pre-open, saying PB Fintech is talking about backward integration with hospitals. The founders convinced this is the way forward, likely plan to provide hospital bed inventory to customers in Delhi. If that works, PB Fintech could be dominant in health insurance distribution market, and the company, of course, has 650 million on their balance sheet so that they can actually build out this model. They go on to say that some may look at backward integration as a meaningful shift from its capital-light business model. Nirav, I want your take on this because the more you think about it, you are a company that sells health insurance online, and then you also help people when they need to use that claim with your own chain of hospitals. So you're sort of an end-to-end seamless provider. Does it seem like a good plan, even though the management has now come and said that, listen, we're not doing anything right now, we're thinking about it?
Yeah, so basically they have outlined their plans for the future, and I think this is something which could take place in the near future. So I think investors would take that into account, and I think it's a wait and watch game at this point of time.
Okay, Shrikant, any view on PB Fintech? And I also want your view on Hero. Let's also pull up what Hero is doing pre-open after that UBS note. Is it having a tough morning or not? So just your take on both of those stocks, Srikanth.
Yeah, I think select for PB Fintech very first, if we see the technical pattern, then it was around some 1950 levels. From there, all the way it corrected back to the levels of 1700. But now if we consider the technical pattern of last few weeks, then it is very close to its support levels and it is relatively doing really well. I'm of the view that the stock is heading higher. Eventually, we are going to see the levels of maybe 2200, 2250. No doubt that it's an expensive stock, but at current levels, I think it is very close to its support levels. And if there is a medium to long-term view, then certainly we should look for adding PV Fintech to our positional portfolio. For Hero Motors, I think there also the formation is quite strong. I think it is not going to correct heavily in the near term based on its technical formation. In fact, if there is any correction, then close to 5800 levels or 5900 levels, the stock is having excellent support. And again, I think the strategy should be to buy on dips instead of adding at higher levels. So I think if there is any correction, then it will be an opportunity for positional traders to create some long positions.
Nirav, what is your word on Hero? There's been a pretty aggressive sell call coming in from UPS. The counter may see some pressure, at least sentimentally today. Constructive on Hero Motor Corp, and if you want to extend that to other auto companies, anything that you like, if not Hero?
Well, yes, actually, Hero MotoCorp has performed quite well in the last 1 year. In fact, the two-wheeler space has been a strong performer. We've seen around stocks appreciate by about 100% in the last, they've doubled in the last 1 year. And we had a coverage on Hero MotoCorp at 3,800. So at this point of time, of course, the valuation is looking a bit stretched. We may see some correction in the stock, but not such an aggressive correction, which has been you just pointed out. But I think at least around 15 to 20% correction should augur well for the stock.
I thought that two-wheelers are in a good space. Just before we get to Mihika, Srikanth, maybe you spoke about Hero, but I'm just trying to broaden that conversation to two-wheelers at large because they've done really well thus far. Is there a buy call on any of the two-wheeler stocks? And at what levels would you, if Hero were to correct, what levels would you buy it again for a trade?
See, for Hero Motors, I think 5,800 is the area of support. There, I think we should look for taking some long bids because the overall trend is suggesting us that the stock is heading higher. When I was going through with the overall consensus, then most of the broking firms are bearish on the stock because of its expensive valuations and the way the company is performing. Even Kotak is having fundamentally a sale call on it. But if we see the technical pattern, then I think it is forming some higher top, higher bottom series. And for traders, whenever there is a momentum and if there is a specific formation and pattern, we should look for taking those stocks as a candidate to take some trading bets on the stock. So I think close to 5,800 levels, Niraj, the stock is having excellent support. But from the other two-wheeler space, I think, all these stocks are very close to their resistance level and they are just going up and up. Bajaj Auto or TVS Motors, all are very close to their resistance level and we need to be careful while adding them at higher levels. Yes, let them correct to some decent levels and there we should look for taking some long bets.
Okay, point well noted. Let's get in. It's time 9:05. So let's this time around, viewers, we give you the big brokerage call for the day, and my colleague Mihika is joining in with that top brokerage call that we've shortlisted this morning. Mihika, what is it?
Good morning, Niraj. So our top brokerage call this morning is Trent. Now, Citi has initiated coverage on the counter with a buy rating and the target price of 9,250, which suggests a 21.5% upside. And it is to be noted that this stock has already more than doubled year to date. Now, what Citi has highlighted is the higher revenue compounded annual growth rate the company has seen when you compare it to India's leading listed retail companies. And this growth is mainly on the transformation of the company from a single format model, which only included West Side, to a multi-format category model, which not only has other brands but also covers different categories like fashion and lifestyle, beauty, personal care, beauty, etc. They've also noted that the jump in FY25 estimates have been defying the weak consumer sentiment in the market, as well as the slowdown in discretionary spending that we have seen. Now, they do value the standalone EBITDA of the company at 65 times of an EV to EBITDA ratio, and even despite this high valuation, this is a 20% premium, they believe that these valuations are justified given the strong revenue and EBITDA compounded annual growth rates that the company has seen to the tune of 41 and 44% respectively. And lastly, they've also placed Trent at the top of their pecking order in their India consumer discretionary and retail coverage. And now Trent is above other companies like Jubilant Foodworks, Kalyan Jewellers, as well as Devyani International.
9250. Well, it's starting off on a bit of a run is Trent, 7730. And you know, the beauty about Trent is that it's got an investing implication, it's got a trading implication both. I mean, if you look at the last 10 days, Trent has arguably been one of the best F&O stocks to trade because it's had a serious run. But look at the last 12 months, it's been a great investor stock as well because you've compounded returns meaningfully. Now, let me try and take a trading call here. Shrikant, would you trade Trent this morning?
See, for Trent, the technical pattern is suggesting us that it is very close to its extreme overbought level. And if we consider the pattern of last, let's say, at least 2-3 months, then it is hitting higher, but with very nominal gains. So I'm of the view that it is better to be a little bit careful at higher levels. Yes, we could see some higher opening, but it is better not to participate at higher levels. Let the stock correct back to its important support levels, and it has left important support somewhere close to 7,000, 6,900 levels. So which is like at least 10%, 7-8% higher from current, lower from current levels. So let it correct back to the support levels. At these levels, it is better to avoid.
Oh, you can't fight the trend or the trade on Trent. It's up about 1.5%. Shrikant, I don't know, waiting for a correction on this one is how likely, but for now, Shrikant has waited out, but the stock, of course, up 1.5%. You know, we've talked so much about the primary market action over the last couple of months that I think it's imperative for us to tell you how can you even subscribe to a company before it goes to the IPO stage? The belief, of course, for most of us is that unless you're very rich, unless you're very wealthy, or unless you're an institution or an employee, you may not be able to get an allocation to a company before it hits the IPO stage. By then, some argue it may be too late. But like we've seen the case of the likes of Bajaj Housing Finance, even getting a subscription when it opens may not be too late. But let's break this down, explain it to you. Don't be disheartened. If you're a retail investor, you too can subscribe to these companies before they hit the IPO stage. Couple of things that you have to keep in mind, such as the ticket size, the risks that are involved, and more importantly, the kind of investment and the timeline of these allocations. But first up, if you usually, and then this is textbook knowledge, for individuals who are looking at investing into a company pre-IPO, these are usually reserved for institutions, private equity funds, venture capital funds, something popularly known as LPs, which is limited partners that PE and VC companies have. They give their partners or their big investors first right of refusal to go into investing into companies. If your friend owns the company, nothing like it. If your family owns the company, nothing like it. You can get an allocation there. And also, if you're an employee in the form of ESOPs, you could have allocations to a company before it hits the IPO stage. Well, that's largely how this business gets done. And those are the big guys in the business. But if you are a smaller retail investor that is looking to get a piece of the pie, and if you're getting carried away when you're reading about a Madhuri Dixit or a Sachin Tendulkar or a Karan Johar allocating to an NSE or Swiggy, don't be disheartened, because there are ways you can do it. And now those also come with high risk, like I said. Well, let's quickly move on and take you through the indirect ways of somebody who's seeking an IPO and allocation. First up, companies offer these shares, like I said, to their employees, friends, and family. One way to do this is you can jump into this by having some of these employees, friends, or family who are looking to offload the stake that they own before the company lists. I think if we can just move on to the next slide, that should be useful. Is Okay, can we continue to move on? We've already talked through all of this. Well, yes, the way to do this would be that you have these friends and family sell it to you. That's an easier way out. It's a simple transfer and you get an allocation to this. The other way to do this is how private equity and venture capitals do. Ultra HNIs, like I said, can invest in a company before it goes through IPO by investing in this private equity or VC fund. There are also others like a 360 that have funds that only invest in pre-IPO, right? It's the fund 1 which had a big allocation to NSE for 360. Then you had fund 2 which is an allocation to Swiggy as well. So investors, but ultra HNI investors have managed to get an allocation to this. The problem here is the minimum size could range anywhere in the range of 1 crore to 5 crores. Some of them also AIFs. So that makes it slightly more complicated. Then again, there are wealth management firms. So you have the likes of an Edelweiss, to name a few, right? Edelweiss, Nomura, JM, a whole host of wealth management firms which will bring pre-IPO companies, unlisted investments to their clients. Now, what these firms do is they actually go out and buy stock of these companies and hold it on their books. Over a course of time, they then offload it to their clients at a premium. Again, this may again be limited, may not be as large as 5 crore ticket size, but the ticket size could be in the range of 50 lakhs to 1 crore. Anywhere where the allocation is significant, a private bank or a financial firm like a Centrum or an Edelweiss for that matter would go out and do this. The other one you want to remember, which is probably most relevant for you, is IPO traders. So you have companies like Unlimited Deals, Sharecard, Precise, Unlisted Zone. These are brokerages and platforms that actually help retail investors to get an allocation to a company in the unlisted space. They take on small ticket items, but remember, the smaller the investment, more the premium. So if you're looking at allocating 5 lakhs, for example, to Swiggy today or to NSE, remember you're going to do it at a massive premium. But of course, if you want the piece of the pie, your allocation and ticket size is small, these are platforms that you could look, and these are legit. They're usually called the grey market, and this is where the grey market premium comes from, which we talk about every morning when a new company is listing on D Street. Lots of risk to keep in mind. I'll just quickly highlight 2 and 3 and hand it over to Niraj for market open. But there's a liquidity risk because these are unlisted. It's not like the secondary markets where you own something and get out of it easily at a click. Apart from that, there's a valuation risk. There's a risk to market. There's also regulatory risk and taxation risk. When I say regulatory, is because these companies are in the unlisted space. They don't need to report to the regulator as strictly as companies in the listed space. So you really don't know whether or not what you see is what you get. Apart from that, the sentiment of the market changes. The response may not be as euphoric. And also taxation. There is capital gains you want to keep in mind. Different people, different forms of allocations, taxation becomes critical. So that's a need. I think I've tried and broken this down. Retail investors don't need to be disheartened. You can get a piece of the cake, but you've got to be very careful. There is a reason why this is set aside for the very, very ultra-rich individuals.
I guess so. And I think it's a great submission, Samina. So thanks. A lot of people will be it's an insightful piece, if you will. But let's focus on the markets and how they're opening today. We'll take in some top calls from Shrikant in about 5 minutes from now, because the markets are starting off absolutely flat. There's virtually no change on any of the key indices. Nifty IT should come up if we can, because remember, it's a tech-led bounce back in the rest of the Asian markets. So about 0.25%, nothing too dramatic. Bring up the mid caps and small caps very quickly, just see if they are showing some strength, because yesterday they were weak. I think they are starting off flattish too. Get the heat map up on the screen. It's an absolutely flat market. Okay, Hero Motor Corp reacts to the UBS note. I think this becomes the big talking point. Thankfully, we have addressed this with our guests, but we'll talk about them once more. ICICI Bank, Titan, Adani, Reliance, Axis are amongst the losers, but not really any dramatic losers, but no dramatic gainers either. Maruti, about 1%, SBI Life, Nestle, Shriram Finance, Infi. So it's all over the place. Just that there's a bit more green, a bit little red. The only key takeaway from the large caps is Hero Motor Corp. Tamanna, I don't know if you're marking Ease My Trip, but I certainly hope you do, because that's the other stock that we should definitely keep in mind.
Yeah, Ease My Trip, 5-star, all of them will be marked. But yes, I think one good thing to take away, we're above, the mark that we've been trying to get to, which is 26,000, and staying put there at least in the first few minutes of trade. So that's important as well. What's working this morning? Nifty Realty is definitely working this morning after a few down days, thanks in part to Macrotech, which has really been firing. Nifty IT is seeing a bit of a bounce back, but I'm not sure if that will really sustain over the next few weeks. For today, for this morning, it's not half bad at all. Auto there pulled between a Hero and a Maruti on different sides of the spectrum of buy and sell today, perhaps. What's not working? Consumer durables, metals, oil and gas, definitely feeling the heat. But like Niraj said, it's in a range. Nothing firing too high or going too low. So that kind of a range shows a little bit of a careful situation in the market that has run up this high and on Nifty expiry, monthly Nifty expiry day. But let's pull up specific stocks that we're tracking. Here spoke about Easy Trip and 5-star, both on our radar. And it's basically stake sales which are in focus. In one case, holders have sold stake, that is in 5-star. It opened, it was up in the green in the pre-open session, and right now pretty much just flat. Has the worst passed for 5-star after that stake sale, or are you going to see a bit of a hit? Easy Trip, we know yesterday that the promoters have now sold 13 to 14%. That stock up after the sales are out of the way. More details on who really bought all of that stake required. We have some details right now. So that stock up 3% as well. PB Fintech is the other one in focus. This is when sometimes a denial can also be positive as per at least Bernstein, but not as per the street, at least right now. 2.5% down. Bernstein is bullish, but the fact that the promoters are saying that their plan to extend to hospitals, apart from selling health insurance, is on hold right now, may be seen as a negative. Trent, Citi has a buy call on Trent. And that seems to have helped this morning, 3% up on the stock. BSE has also been buzzing. Remember, there was a report on NSE valuations hitting sky high, and BSE is buzzing right along on that buzz of its competitor coming into the listed space. Uno Minda in focus. They have a deal with Hyundai Korea. Their subsidiary has a deal with Hyundai Mobis actually in Korea to make speakers, 2% up on Uno this morning. CAMS also, they had a management meet with investors and a few analyst notes out on it. So buzzing in that sense, about 1% up. Meanwhile, we've hit a new record high, which is expected when you're in blue sky zone. Both the Nifty and the Sensex are on record highs.
Looking too bad. Nothing great. No big gains across the board. Tech, we talked about this in the morning, that we've been waiting for it to recover, and there is some signs of that happening in today's trade. So some of your tech frontline names are trying to do a little bit of a recovery, and defensive names such as ITC are also seeing a recovery. IT might just be the top gainer in today's day of trade on back of the fact that it's not participated in the last few days for sure. Well, in the broader market universe, Easter planners is up 5%. That rally isn't stopping anytime from after that big fall yesterday. The recovery is there for everyone to see. Signature Global is up 2.5%. Trent on back of another bullish call coming in from the big brokerage is up 3.5%. Also, of course, playing on the defense team today. Mukta Arts, small mid-cap company, but volumes are large. The stock is up 15%. Zaggle Prepaid, there was some news about an acquisition they did. The company is looking good with a 2.5% up move. Uno Minda is looking good. Triveni Turbine is up 2.5%. Piramal Pharma is looking well placed. JBM Auto is seeing a 2% gain. PB Fintech, market men, the street may not be too, I don't know whether they don't like the fact that they're venturing into healthcare or don't like the clarification that they're not venturing into healthcare. One way or the other, the stock is seeing pressure. It's down about 3% as we see it. Well, you've got a couple of the other names in the real estate space that aren't doing too badly. So the Suntech Realties of the world are seeing a slight positive bias. Hero MotoCorp on back of that UBS sell note is trading with a cut of 1.5%. On the sell side, apart from UBS, you've got a whole host of names that are seeing some pressure. So Crompton is down 3.5%. Insurance companies are taking a bit of a backseat. Real estate ancillary like a Kajaria Ceramics is down 2%. Fertilizer names are not looking too good either. So it's more or less a half and half picture. but definitely showing signs of fatigue. The Nifty is dragging itself. It is looking okay right now. But remember, it's also the monthly expiry. We are at a record high, 26,045 on the index. But fatigue is obvious. Shrikant, it is expiry that is looking tired. We've had a good run for the last few days. Anything that you've spotted as a trading opportunity today?
Yeah, I think see, like at these levels, yes, there are a couple of stocks which are really doing well. From the IT space, TCS, I already initiated in the morning. There, I'm expecting that the stock can do really well. But we also like Wipro, because whenever there is a rally, specific rally in IT stocks, we see specific participation from Wipro. It is currently trading around 540, 539. But based on its technical formation and long-term formation of the stock, I think stock is heading towards the levels of 600 plus. At this level, it's a buy because the overall momentum is there in the space with a stop loss close to 530. The other stock on which we are bullish is ITC, and the reason is that the stock is forming some rising corrective pattern, which indicates that the stock is like going to surpass its previous high of which was somewhere close to 520.23. And after crossing this level, the stock can move to the levels of maybe 540 or 550. So ITC is also a candidate to buy at current levels with a stop loss close to 510. Again, it's a heavyweight stock, and this time, whenever there is a rally in the market, we are seeing specific buying interest from all these heavyweights. In fact, we are also expecting some activity in the Reliance Industries, but if there is a positional view, then we should look for adding Reliance at current levels. But otherwise, I think today, or for next few days, ITC is the stock to watch out for.
Okay, ITC is stock to watch out for and focus on the heavyweights. But Shrikant, what are you thinking about a BSE this morning? And also let's talk about a bit of up move coming back in a SpiceJet as well. After more details of sales from Carlyle, SpiceJet, Easy Trip, 5-Star, all of them have been moving one way or the other on the fundamentals of stake sales. But on charts, any of these that you're liking?
I think for BSE, it is like it is consolidating at higher levels. So it is better if we see any correction in the stock somewhere close to 3,500 levels. At this level, it is like very close to its overbought level and resistance level. So it is better to stay away. For Ease My Trip, I think it is trading below its important support level of last 2 years. So based on its technical formation, I'm expecting further fall for the stock. It is better to stay away. For 5-Star, yes, we are specifically bullish on the stock, but there is like specific news flow and block deal has happened. But at current levels, around 800 levels or 790 levels, certainly it's a buy if there is a positional view of next at least 6 months. So it's a buy at current levels, but positional view should be there. And finally, for SpiceJet, especially, I think, see, like the overall technical pattern of the stock is suggesting us that the stock is heading higher for the levels of maybe 90 or 100 in next few weeks or months. So it will take time. It's a positional call. It's a long-term call. And at these levels, it is quite attractive. It was because few days back, it was around some 75, 77 levels. So SpiceJet is also, I think, a very decent candidate to buy and hold from the small cap space.
I think media has had a bit of a good move this morning. Hindustan Media Networks, I think Network 18, TV 18, a clutch of these media names seem to be doing okay in the session today. And Auto Angs, I think the BOFA upgrade on Sona Comstar has led to that stock and a couple of others, Motherson, Jai Bharat, etc. doing okay. Jai Bharat Maruti is up 4.5% if I'm not wrong. The volumes out there could be a bit suspect. So there are a few names which are kind of okay. Nirav, heady levels, have you guys as a house initiated a recent buy call in the last 2 or 3 days? And maybe there are more, but nail it down to that one top idea that you have conviction on.
So at this point of time, I think we've been quite bullish on certain ancillary sectors relating to the metal space. From the steel perspective, I think we like graphite electrode makers. So we like Graphite India Limited, we like HEG, we like companies like RHI Magnesita, John Cockerill and Linde India. We particularly like all these themes from a medium to long-term perspective.
But what's the earnings rationale for this, Nirav? I mean, have you made some assumptions about what they could do over the course of the next few quarters?
With respect to graphite electrodes, I think Graphite India and HEG, both of them have very strong balance sheets. They are cash-rich companies. Till now, the pain point for the companies was the falling realizations. But going forward, the realizations are expected to firm up. We already have the demand, which is quite strong. In both these cases, the exports account for around 70% of the total revenues. At the same time, the capacity utilizations have already hit 85 to 90%. So I think the going is very good as far as from a valuation perspective also. And I think from Q3, Q4 onwards, we'll see a marked improvement in the performance of both these companies. As far as Linde India is concerned, I think they're a big beneficiary in terms of the demand for gases, and the project engineering division is doing quite well. They have set up air separation units. They are doing a good amount of business with Tata Steel and with Kalinganagar plant coming up. I think the best is yet to come as far as Linde India is concerned. So I think these broad themes, we've got a good amount of valuation comfort with respect to all these 5 companies which we have discussed. We remain positive.
Shrikant, in banks, would you look at buying Bank Nifty today or any of those banking stocks? We've talked about this, I know, pre-open. But now that markets have opened, there's a little bit of a bias. Banks are picking up again.
Yeah, I think so. Like we can clearly see that all these private banks, they are really doing well. And whenever there is a rally in the market or in the broad-based market, we see specific buying interest in stocks like HDFC Bank as well as ICICI Bank. We also like Axis Bank, which is around some 1270, and specifically there we are expecting stock to move towards the levels of at least 1330 in the near term, but maybe 1450, 1500 in the long run. So Axis is also something which should be on the watch list. We also like IDFC First, because there also they are forming some base building formation. So again, if there is a long-term view, then at these levels they are quite attractive. We also like Federal Bank, we also like RBL Bank, and most of these stocks are very close to their support level. So downside is like quite protected. And if FII's trend of buying continues for next, let's say, couple of weeks, then I think these stocks can also do well. So RBL as well as Federal Bank should also be on the watch list.
Okay, just wonder what Trent is up to. Just one very quick mention here, because I think Tamanna wants to ask something to Shrikant, but just want to mark Trent. 3.5%, 263. This is an expensive stock getting into the Nifty. Inflows of $650 odd million expected between today and tomorrow. A city upgrade. It had all the right ingredients. The stock is killing it. 3.5% for what has been touted as, rightly so, as a very expensive stock.
Well, I know Trent is looking good, and that was a big brokerage. But if you just track Shrikant's 2 calls, Wipro and ITC, in the last 5 minutes, Shrikant, and this is good on you because you call those counters and both of them are seeing big volume movement. Wipro is up about 1% now since you last called it, and ITC also is looking quite good with them now.
Yeah, I just wanted to ask about auto stocks. Nirav, and quick take there. Maruti doing fairly well today. M&M, after all of the buzz on the two-wheelers, do you think that with a Hyundai IPO coming in, you'll see some action on the passenger vehicle space as well? And if yes, would you look at a Maruti?
Yes, definitely. I think can expect some positive rub-off impact on these four-wheeler makers, and I think Maruti and Mahindra and Mahindra could benefit on account of this.
Okay. Well, we'll watch out for some of these stocks, but thanks so much, both of you, for joining us. And well, we've got a wide array of stocks, so really appreciate that. But we should focus towards the pharma sector. The Biosecure Act was touted, or has been touted, as a big game changer. We thought, let's understand the brass tacks of this, and we spoke to Jonathan Hunt and Sibaji Biswas of Syngene on the opportunities that could arise from this and the impact on pharma companies at large and Syngene in particular. Listen into a small slice of that conversation.
I think actually it sits on top of a broader trend, and you've really got to look over the longer term, there's been a gradual sort of rising of competition between particularly the US and China. There's a real sense politically in the US that, as the China economy has grown, that it becomes a direct competitor to the US's sort of global economic leadership. And the politicians there have had rising concerns for a while around when does that relationship go from being collaborative to one that's directly competitive. So that's at the sort of the political level, and this has been rising for a number of years. If you look then at individual industries and firms, I think actually the Biosecure Act is a piece of legislation. I'll say a little bit more on that in a minute. Sits really on top of this broader concern that we've all got, and really the COVID pandemic heightened it in boardrooms around the world. What's your supply chain resilience? Have we all over the last decade or more overstretched our supply chains so they become ever more efficient? But, if it's too taut, it snaps, and you don't really have that sort of fallback built-in redundancy and resilience. All your eggs in one basket, wherever the basket is and however good the basket is still a single source risk. And I think COVID taught a lot of, many industries that we'd gone too far in that direction. So there's a sort of macro trend there about balancing supply chains, building in dual source redundancy. And then you add on top of that a specific piece of legislation in the Biosecure Act for our industry, which calls out 5 specific Chinese firms that the government believes may be aiding state-level competition between the two countries, and they're looking potentially to prohibit American corporations, and particularly those that receive government funding, from working with them. But that sits on top of this broader trend. So opportunity for us, well, India as an economy and companies like Syngene in our industry are possibly the closest in capability and scale to what the Chinese leading firms offer, and therefore we become an obvious choice if people want to switch. And that really has been the trend of the last year, is our customers coming to India, many of them for the first time, probing, testing, auditing, searching, and trying to see, are we ready and are we able to fill some of that gap as they want to rebalance their supply chain. So I think the Biosecure Act sits on top of it. It really focuses the attention. But the underlying trend is there anyway, which is it's around supply chain resilience, choice. And I think we're well positioned as a company. And then I think for more broadly the Indian economy, it creates a favorable environment.
Certainly. But how longer term is this, Jonathan? As a follow-up there before I get in Sibaji in the conversation as well. How long-term out is this? Because you are right that there is an underlying trend. Maybe this sits on top of it. But because it has been passed, there is a specific impact of this, which a lot of people are not quite able to comprehend. So can you outline that for us a bit? And I'll ask actually the same question to Sibaji after that.
Sure. Yeah. We can chime in together. I'd go back to the first draft of the legislation, and the way it was first written, it looked very much like it was going to trigger almost a crash dive for the entire industry because the timelines were very short. It was suggesting that you had to get this done inside of 12 months. And then you've got to go back to the nature of pharmaceuticals and biotechnology. These are very long cycle industries, very long cycles around technology. And quite rightly so. If you think about it, we're trying to innovate and find new medicines. They need a rigor in testing and in development. You want to be really certain before you start exposing a new chemical entity to patients around the world. You want to be confident on its efficacy. You want to be confident on its safety. And it requires a long-term investment. It takes between 8 and 12 years to discover and develop a new drug before you get it to the very first patient that's going to take it. That then means that the supply chains are equally long-term and rigorous and audited and regulated. And that means that the industry's pace of change, its direction of change is clear. Its pace of change is very, very sort of moderated and controlled because we have to get it right. And that then I think indicates, I think this is a positive wind for 5 years, for a decade. It's not for the next 5 weeks or the next 5 months. So the legislation will play out, I think, during the political cycle in the next year in the US. But I think the rate of change that I'm seeing from customers is very controlled, very planful, because if they're uncoupling a manufacturing supply chain, it could take you 2 years, even if you're going at a sprint to do a tech transfer, because of the amount of regulatory control that's needed, the amount of proof and evidence. So powerful force going in a favorable direction. I think it plays out over the next 5 and 10 years. I don't think it's an immediate overnight sensation over the next 5 weeks or so. But that's pretty good. I mean, there aren't many industries can look forward and say, I can see a favorable wind for 5 and 10 years.
A big thing as well. Sibaji, you want to add something to this?
Yes, I think we are already seeing some healthy lead indicators, but as Jonathan pointed out, it's a long-term, mid to long-term, 5 to 10 years trend. We are seeing a lot more inquiries, a lot more pilot projects. It's basically, the companies are trying to test and then grow. So it's a phase where many of those international innovator firms are building confidence in the Indian organizations, particularly if they've never worked with Indian companies. But it's a 5 to 10 year trend. It's very pragmatic because even to scale up to the kind of volumes that today happens out of China, it will take time even for the Indian organizations. So it's a good 5 to 10 years traction that we are able to see.
Yeah, no, but Sibaji, my follow-up would be that it's an opportunity for the longer term. Does it come into effect for lack of a better sentence, does it start showing in your books very late, or does it happen? And when does this happen? I mean, let's just kind of get that out of the way.
It will build up gradually. As Jonathan mentioned, it is not a 5-week trend.
Yeah.
As I mentioned, that there are a lot of inquiries, RFPs, pilot projects. Those, when they convert into bigger opportunities over the next 12 months, 18 months, 24 months, they will start showing up in the financials as well. But it's not a trend for the next quarter or the following quarter. But as we have guided previously, that from second half onwards, we expect to see improved growth and improved top line performance. That's where I see the trend beginning. But it's again a trend over the next 5 years at least.
I'm glad we laid it out. So it's for the patient guy to look at this. It's a long game, viewers. Remember, Jonathan has been candid enough, Sibaji is candid enough to say it's not a 5-week sprint, if you will. Now, Jonathan, fill us in on what you think. One could be the client considerations in light of the Biosecure Act about when they go out and choose the partners, and your strategy to take advantage of this legislation that has been passed.
Yeah, sure. Let's split it into the different bits of our business. So research, discovery, development, manufacturing, and look at it through those lenses. I mean, one of the behaviors, that change in the legislation where they extended the sunset clause from get this done in a year to do it over sort of 8 years out to 2032, that changed the behavior really quickly, because an awful lot of research projects are, back-to-back series of 12 months, 18 months programs, and you work on a program, you get to a scientific outcome. At that point, you decide whether you're going to reinvest and do the next phase of the discovery. I think at that point, many clients decided, look, we'll let what's in China run its course. It's only got a year to go. It's only got 6 months to go. So we'll let that run its course. And then the focus becomes, where are we placing the next piece of work if successful? So, our response to that, as you'd expect, is dial up your visibility, make sure that your sales and marketing, make sure that you're front of mind with those customers and that you're giving them the options. But the option is for what they do next once this phase of their work is completed. So we're pitching on, phase 2, phase 3 of their programs, and that's predicated on them being scientifically successful. So that's a little bit of the tone and the tenor on the research side. On the development manufacturing, it's similar, but it's much more structured. If you wanted to move manufacturing a product from, an operating unit in China and you wanted to move it to India, it might be 2 years of technology transfer. You've got to revalidate all of the processes. You've got to make sure the regulators support what you're doing before you even get to the first batch. It might take them a year to do that sorting and selection. So even going at a sprint in this industry might be 3 years before you're starting to do the operational work and see it in your revenue. But that's the same for everybody. So, my P&L will build in the same way as my competitors. That's just the rate of pace in the industry. I think the other bit that you're also seeing, which sits outside of the Biosecure Act, is just a long-term cyclical trend that you see, particularly with the bigger biopharma companies. As you know, they tend to have these surges in innovation and success, and then that, of course, inverts as the patent on those products expires. That creates a revenue dip for them, and they're constantly looking to find ways to infill and paper over that. And it's a combination of either accelerating their internal programs, but also managing their costs. That's quite a trend at the moment. You see a number of companies restructuring, reorganizing how they operate their business, and that's also creating an additional opportunity for us. Can we do things for them out of our India operations that they traditionally would have done in the West, but can we do it with scale and flexibility and quite often an operating cost advantage? So there's more than two positive drivers in the industry at the moment.
Very interesting. So, okay, so that's it's interesting to note that there are pulls and pressures around this as well. And therefore, Sibaji, the question that would come to mind is that because the street believes that CDMO players are the ones which will benefit, and it might be a long game, but do inquiries and therefore, as you say, RFQs sometimes inquiries, sometimes initial orders, testing orders. When do these start showing up? Part one of my question is that. Part two is, and both you and Jonathan can, in his words, chime in. Once you cross the first leg of this small order, maybe clients come in with a smaller order first. Is there a J-curve effect in how they approach it, because they will need supplies and the Chinese supplies are definitely going off?
Yes, so we already have spoken about it over the last 6 months. In the run-up to our July quarterly results, which we declared, we had seen 50% higher RFPs and inquiries. We spoke about that, and that trend continues even today. So I think in terms of customers reaching out to us, that has already begun. The small projects will take its own time, and the pilot projects has its own duration. But over a period of next, as I said, 1 year, 2 years, they will start converting into bigger opportunities. Of course, the execution is very important over there. So the leadership team over here is fully focused on executing it well, so that we build a necessary level of confidence that can then put us in a good trajectory for the next 5 years. But again, it will start showing up over a period of time and build up over the next few years.
Jonathan,
make a comment on that. Remember, one of the reasons investors in the street are enthusiastic around the opportunity for India and for CROs, CDMOs, is because that nature of that work is inherently very sticky. Once you are ingrained and you're working together and you're delivering, the transaction costs and the challenges of moving it to another location, another site, or another supplier, those barriers are quite challenging. There's very good reasons to stay where you are. So the stickiness creates part of the attraction of it as a business model, and therefore it gives you good long-term visibility on your cash flows and your profitability. At the same time, it's sticky with the incumbents. So disconnecting or decoupling out of China, you've got to overcome that same stickiness. That's why it takes a little bit of time. So the direction it travels there's good reasons to do it, about rebalancing supply chain risk, as well as sort of, the driver of the Biosecure Act and the geopolitics. But you can't sort of like the attraction of it being a sticky, stable, long-term business and then complain, but it takes a while to switch it. It's the same, two sides of the same issue.
Yeah, fair call. Okay, in which case, I'll not flip really, but ask an extension to this question. If indeed some of these things take time to get proven and proof of concept or what have you, how do companies such as yours, which will be participating in this, get the confidence to incur the capex cost because the timelines are not necessarily known, or even if the timelines are known, that you will get orders, let's say in maybe a couple of years' time, because you have confidence in your capability, the size of the orders will not be known while you're doing the pilot. So how are you preparing yourself for the upcoming quote-unquote wave?
Yeah, sure. Well, some of it is the capex that we've already put in and the headroom in our own organization. We've deliberately been investing in recent years for growth, not only from the China rotation, but because we see in general there's a structural shift to outsourcing, and there's a structural shift to outsourcing to companies like us that have got good capabilities and can match the service levels in the West. But we do it with a scale and a flexibility and an operating cost arbitrage that's attractive. So there's a headroom for growth in our business already. But you'd have to look, maybe it's the difference between a CEO and a CFO. What a nice problem to have, that we're going to have to debate whether or not we put more capex in because we think there might be more demand in the market than we previously predicted.
Well, that's Syngene and gives you an idea of the CDMO opportunity because of the Biosecure Act. The whole conversation will be on our digital handles, and I'm sure it'll play out later on in the day on television as well. But on to another exclusive chat. Thermax ties up with UK-based Ceres Power for electrolyzer technology. My colleague Vikas caught up with the CEO Ashish Bhandari on the roadmap going ahead. Listen in.
Green transition is the buzzword right now, and especially in the power and the energy sector. There is one company, Thermax, which is providing energy solutions in this space, and we have with us Mr. Ashish Bhandari, who is the CEO of Thermax, to talk to us about the plans in the space and also the roadmap going ahead. Welcome to NDTV Profit, Mr. Bhandari.
It is my pleasure to be here. Thank you.
So you all are participating in this event. This is a boiler turbine event where you all are planning to go green big time. So can you talk to our audience what exactly your plans are in this space and what are the solutions you are providing?
Sure. यहाँ पे for our audience out here, there are three big innovations that Thermax is talking about, and the whole move towards energy transition is the core of everything new that is going on at Thermax. First, you would see out here is a biomass center of excellence, as part of which we have got new products and solutions that we are releasing. But at the core of it is we want to come to the market and say any problem that you have for biomass, any problem statement, come to Thermax and we would work with you on what is the best solution that is possible to work a transition. If you're using coal or fossil fuels and you want to move towards biomass, we will do everything along with you. How do you change existing equipment? Where is biomass available? New equipment if you want, we can help you with everything. The second big change that you will see is a big move towards electric. Yeah, we know going forward, electricity and green electricity will drive a lot of energy, which means Thermax's equipment also should be ready to work on electricity. So you will see a whole family of solutions that are coming in, which are starting to provide boilers, heaters, even some of the lower volume equipment meant for hospitals and hospitality, etc. All of which will run on green electricity, and you will see a big transition towards that. Third, you will see is a move around digital, where we are introducing a family of solutions with digital at the core, with good strong basis in AI and ML, helping our customers use digital to provide asset availability and asset efficiency. So those are the three big innovations that you will see. In addition to that, we have a whole host of new products, new capabilities across the entire range of Thermax.
Yeah, so recently and for the last couple of years, we have seen that pollution is a big problem, especially in North India. And parali, as you know, so biomass can also be parali. So what are the solutions you are working on that side, and if you are working with municipal corporations across India? Sure.
Parali in particular has a problem, which means when you put it in boilers, it creates problems in the boiler, which stops the boiler from working, simply put. So the best solution for parali is to convert it into CNG. Yeah, and we are working on core technology to convert this biomass to CNG. And we are working on multiple plants right now in the northern part of India, which can deliver this. currently, all of these plants are in the execution phase. Once the technology is proven and we can execute and show we can do it at scale, we think hundreds of such plants are possible, which is also the example which I was talking to you about. Parali today is a problem, and you can actually make that problem into a solution. India today imports a lot of natural gas. If we can convert this parali into natural gas, we do import substitution and take something that burns into a source of value for everybody else. Yeah, and this is part of what the government and what the Pradhan Mantri has been talking about. And it takes something that is waste, converts it into something that is value.
So I've seen, on the demos also that you have some CNG plants already from biomass. So those biomass is still not using parali is what you're trying?
No, those are all on parali grass converting to CNG. And the reason I was saying was all of those plants are under execution and final commissioning. Only after that is complete, we can come and say we have solved the problem, so to say.
So Thermax till now had been involved into conventional kind of solutions. So now slowly you are shifting towards green. So does that mean you would still stick with coal-based solutions, or you are completely moving away from it? Because now government is saying that come back to coal.
Look, Thermax's focus is energy transition, which means, and we are very much part of the Indian fabric. Yeah, and coal is very much part of India's energy story. So the question is not that you can't work with coal. The question is how do you make coal cleaner and more efficient. So Thermax has been working on coal gasification as an example for the longest time. We have got solutions around flue gas desulfurization and variety of efficiency solutions that are around coal. So we are never against coal, but we are very focused on how do you make coal cleaner, burn better and make it more efficient. That is our focus.
And you also have flexi boilers,
boilers, yes, where you can run coal along with biomass, along with municipal solid waste. Yeah, cutting down the energy footprint, not saying no to coal, but how do you reduce the overall carbon footprint? That is our focus.
And you have a total outstanding order book of around 10,500 crores. Out of that, how much you see in forms of breakup if you give? How much is from the green energy side and how much from the conventional?
Our numbers change quarter to quarter, but typically right now we are running about 70% of what we call as green, 30% of traditional fossil fuel. That's roughly the breakage that we have.
And what is the execution timeline for the order book that you have?
Look, it ranges here. Our execution timeline ranges from 1 month to 3 years. The longest projects that we have are slightly more than 24 plus months in execution. And the shortest ones, especially on the services side, there are many projects in smaller product portfolio, which we do in 1 to 2 month turnaround as well.
So this 10,500 crore gives you a visibility of how many months?
It gives us a visibility of maybe a year, that's it, on average.
And a couple of more questions. One on, you recently spoke about electrolyzer business that you plan to enter into, no? That you are setting up your own technology since you have expertise in heat management. So can you talk a little bit on that?
Sure, we are very excited about hydrogen as a technology for the future. And especially in India, for many of India's hard to abate industries, especially steel, refining and petrochemical fertilizers, the transition to hydrogen will be an important one. And as part of it, we think solid oxide technology for electrolyzers is a key technology that can make this transition happen faster. So Thermax is partnering with an international company, Ceres, on SOEC technology, where we have a global license on this technology, on the basis of which we will be working on building solid oxide electrolyzers in India, complete localization, complete capability, and over the next 2 years, we will indigenize the technology and then do manufacturing of this out of India as well.
So what is the kind of investment you all are doing on this?
Look, the investment will change depending on the success that we get at each stage, but we are prepared of hundreds of crores of investment on setting up full-scale manufacturing capability for solid oxide capability.
One last question, given the kind of opportunities that you see around yourself, your first quarter margins were slightly impacted because of industrial infra. So with this kind of opportunities lined up, do you see margins improving?
I do expect our margins to improve. I think Q1 in particular, we had some exceptional hits, which were all execution, so they were not exceptional as such. But on our bio-CNG portfolio in particular, and on our project side, we had items which resulted in one-time hits that we have to take. Overall, I am optimistic that our margin profile, which has been improving over the last 3 years, will continue to be on a trend of improvement.
Thank you very much for talking to NDTV.
Thank you so much.
Thanks.
It's been a pleasure.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, as we are wedged between a rate easing cycle decision by the US Fed and the US elections, is this on your screen. Will rate cuts bring in flows to emerging markets and India? Is India expensive for a 10% downside? Because that is what a lot of people fear. And within sectors, are private banks, the largest and arguably one of the cheapest large sectors, poised for upsides over the course of the next 12 months? That and more with our guest on Talking Point today, Vikash Kumar Jain of CLSA. Vikash, so good having you. Thanks for taking the time out. I hope all is well.
All is well, Niraj. Thanks for having me.
The pleasure is always ours. Vikash, I want to start off with this. How do you see what happens to emerging markets in India in the wake of a rate easing cycle? Because if we look at the past history, and enough number of times and enough ways this can be dissected about what happens to markets over the next 12 to 24 months, the view isn't quite clear.
Sure. I think the view isn't clear because we're just focusing on the action of rate cut rather than the reason why the rate cuts were done historically. So that's where it is important to understand why the rate cuts are happening. Soft landings, which the market is talking about right now, are actually rare. That's something which has happened only a couple of times in over 100 years of history for the US. That's why many previous rate cuts have not followed up with great market action. So I think rather than following what happens after the rate cut, we need to focus on the reasons why the rate cuts are happening. If I think at this juncture, at least the equity markets have taken a comprehensive and a convincing view that we are getting into a soft landing. That's not how commodity markets are convinced. And there are differences over there. Since, I'm not trying to draw a parallel to 2008, but since that's something which is more recent in memories of many of us, sometime in the fall of 2007 as well, we were arguing, that there could be a soft landing, I think. And what happened in 2008 wasn't really the prettiest of pictures. What we need to appreciate is many a times rate actions take time to play through into the economy. And that's the bit that markets, many of us in the markets aren't really that patient. And if a particular rate hike or a rate cut or a lack of one has not led to any significant change in the near-term economic picture, we start thinking that, more or less we have digested all of that. That may not be completely true. So that's why I think the jury is still out. However, what we need to, the way we typically, my personal way of looking at markets is to try and predict how narratives will move rather than predicting the eventual outcome of things, because the eventual outcome at times is something which takes much longer for us to figure out with a lot of accuracy. So it's important how narratives move when trying to position portfolios as well. And that is where I believe yesterday's consumer sentiment data point that came out of the US wasn't really the best one. I would say come the Friday after this one, we will have the jobs numbers and the employment number. That's going to be very crucial. I think the focus now shifts away from inflation and shifts more towards some of these metrics which measure the health of the economy. If employment falls in a more dramatic way over the next couple of readings, then that's where suddenly rate cuts per se will not be seen as exciting, but will be seen as more necessary. And, so that's the bit that we need to keep thinking about. So I would say those first Friday of every month, the job reports that come out, that become far more important over the next few months and could be one of the days which can cause a lot of volatility. So that's something that we need to watch out for.
Okay. Well, the reason ascribed could be an important determinant as well, as Vikash is saying. The question though is that, Vikash, the question of course is that, one, because it's a mug's game trying to identify what the markets could do. I'm not saying you guys do that, Vikas. It's a job compulsion to give out targets. So you're, of course, doing it very well over a 12-month period. But I mean, over a 15 or a 30-day period, I would presume it's a bit of a mug's game to try and do that. My question, though, is what might be a lot more informed opinion from you for us would be what is it that you reckon could happen to flows, and what is it that you're gauging from your clients about flows into India now that the easing cycle has started? Is there a one-to-one correlation between an easing cycle and flows into India? And if not, what are the nuances this time around for inflows into India?
I think that's a very relevant question, more so in the last quarter of this calendar year. Those flows will be very important because we get into, I would say, a pretty big period of supply coming in equity markets as well. So that's where more FII inflows will be required. However, can that be taken for granted? We do not know. See, if there is a rate cut and this narrative of soft landing continues, then we can be hopeful of more inflows into EM market. However, if this narrative of soft landing comes under a bit of doubt, even under a rate cut, an investor sitting in the developed world would not feel comfortable putting money in a more risky asset class. That's how they would view emerging markets as. Then there will be no such major incremental inflows. Why those two scenarios are very, very important is to add to all of this, what makes this whole cocktail even more interesting is what China has been doing over the last few days. Although I have to say, whatever feedback I've been getting with my global colleagues, they believe in the action taken by the Chinese authorities in terms of being able to cause a more sustainable rally is still very low. However, if there is a rally in the Chinese markets and we do not see a lot of incremental inflows coming into EMs, then there's going to be allocation away from India just to chase that rally, because it's become a consensus underweight China. So that's the other thing that we need to kind of bear in mind. To bring all of this to make more sense to what is happening closer home in India, we head into a period where there's going to be, a big race in terms of supply that we will see for this quarter, if you were to believe many of these media reports and many of these, upcoming IPOs and other fundraisers, if they were to be successful. I think the number that we are looking at is about $7 billion of total IPO that has been raised, only IPOs, so far in the first 9 months of this calendar year. The number that could come in could be much more than that in the last 3 months itself. So there is definitely a requirement of more inflows into India, because if that does not happen, then a lot of the foreigners who are interested in these IPOs may simply sell out of the secondary market and invest there. So clearly that could cause some nervousness in the already listed secondary market space. So in fact, like for example, last month, the month of August, where we saw a pretty big increase in weight of India. Despite that, the total FII inflow was only about a little over $1 billion in that month. Now, where that came from, there was a very big buying by non-India dedicated passive money that came into India, but a large part of that buying was from non-India dedicated active sellers. In fact, although there was over $1 billion of inflow in the month of August, more than that went into the primary market. So secondary market actually saw a small outflow for foreigners. So that is where I think getting this incremental flows from an FII flow perspective will be even more important than any of the last few months, because we are likely to see a very big, supply coming, very, very big demand for new IPOs coming into the market in the last quarter.
Vikas, it's an interesting point that you raised, because I mean, when I did, and correct me if I'm wrong, of course, but when I looked at the last 12 to 18 months, I thought the foreign participation has been pretty decent in the primary markets, if you will. And primary market subscriptions have looked very, very robust. I mean, we just closed the small IPO, of course, but that got subscribed 224 times. Another one which is open, again a smaller one, subscribed 24 times on day one. It's quite strong, this appetite for primary paper. One, is it desirable? Because if there is no primary paper, then liquidity can take the markets to bubble territory. And two, does it worry you, or is it okay that with the kind of liquidity sloshing around, you will get oversubscription, but why should that be a problem? Because the stocks will eventually list and do what the earnings determine them to do, right?
So, see, okay, so what I was trying to say was more about the impact of that offering supply on secondary market.
Yeah.
But I think there is a need. There is still a section of futuristic industries which are not very well represented in our benchmark. I would say if you were to compare the top 10 constituents of Nifty over the last 10 to 15 years or even a little longer, most of them have stayed constant. That's not the case if you were to look at many other large economies, because many of new age kind of companies, whether you look at the US, whether you look at even China, many of these tech companies and some of these other companies are now better represented in the market. So whether this is something which is which I'm worried about, not really. I mean, from a longer term perspective, it's desirable that the index, the primary index of the primary market and the index of the country is more representative of where the growth is expected to come from. So I think that's desirable. From a shorter term perspective, what you need to appreciate is the rush towards primary offerings is also to do with the fact of that there is a significant lack of ideas that we are facing in the secondary market, and to generate alpha is very, very difficult. To get an upfront discount and a large allocation in one of these things, although that's difficult, but to try and get that is what institutional investors are after, because that's where a lot of the alpha for many of the listed funds have come from.
But Vikas, sorry, may I just ask? I can understand if the nature of the paper that would have come in would have been of a completely different nature. Like, I mean, I'm just saying, for example, if Zomato's got subscribed with an IPO today in a massive fashion, because it's just a differentiated business model, a lot of companies which are getting subscribed are not really, I mean, for lack of a better word, differentiated. There are parallels existing with proven records in the secondary markets as well. And it's not that the primary guard paper is coming at a very high discount, right? So then why? Or is your opinion different?
No, I do not differ over there. See, I think what you need to appreciate, I think we are also at a point where if you talk to many people privately, it's the kind of valuations that you're able to get in public markets are perhaps even better than what you're getting in private markets. So there is obviously a rush to invest and to raise money in public markets. In that process, see, we can't regulate all of these things. It is, it's not for you and me or anybody to ration that. That's the beauty of how capitalism works. And in this process, of course, there's going to be some disappointment, some failures. If you look through, for most sectors, if we look at valuations for those sectors in India and for those same sectors across the world, in most cases, I won't be surprised to find that India is the most expensive, valuation, not just as an overall market, but across sectors, sector by sector. Like, an Indian consumer company would be the most expensive in the world. I would say Indian tech companies could be nearly the most expensive in the world. So, those are things that what that does is clearly a way in which you kind of try and monetize that thing. Eventually, a market like what we are in at this point of time will possibly supply is what will bring it down. Because unlike many other previous, if you were to look at history and the history of large corrections that have come in global markets, that have typically coincided with something wrong happening with the economy. If you were to look at EMs, then discipline going haywire of some kind of deficits getting created, leverage being there. Those worries are not there in India right now. That's the good part of it. Most of the worries that we have are more to do with excitement in the equity markets and perhaps that excitement getting frothy or not frothy and those parts. See, this is likely, if it's an equity market problem, it will be solved by or if it's an equity market excitement, a problem will be created in equity market, and that problem might very well come from supply. And it could pretty much, how it could come if there is too much supply, and at the same point of time, supply comes at a time when foreigners are not able to plow in a lot of incremental money, but simply take out money from secondary market and reassess that. So that's where some of this could happen.
Are your clients telling you that? I mean, because, for example, we were at one of the other investor conferences of your peer groups, and there the conversation seemed to be that people are actually looking for avenues to invest into India. They recognize that some parts of India is expensive, but they still want a piece of India. What are your clients telling you?
So I would say the discussion needs to move in terms of when you put horizons in perspective. Sure. What you're saying is absolutely true. And so we had our Big Asia Forum in Hong Kong very recently, and where we possibly end up getting almost 2,000 investors over there. Very, very busy conference, very well attended, possibly one of the most popular Asia conferences. What I could sense was clearly a massive a massive liking for India. However, that does not translate into immediate flows because people are not comfortable with valuations. Okay. So I think the way I will read that is the two things that I said. Firstly, there's a massive liking amongst foreigners for India. Secondly, at the same point of time, we don't really have an economic problem. We only have a stock market. Yeah. Both of those things mean that if there is a stock market problem leading to a pullback, perhaps the pullback will not be deep enough. It will be a relatively shallow pullback rather than a 40-50% correction, which we typically think of a bear market. It will not be that much.
Got it.
Because the longer term story is still pretty powerful.
Pretty powerful. That's true. Okay, now just before I get my colleague Harsh, Vikash, you made a point about how representation of sectors or themes which are not well represented should be there, and those which get earnings growth, etc. This whole new age tech sector that has gotten formed, what is your view here? Because, for example, I read a note which had a very nice tagline from your house, which said, are you talking about an urban slowdown? Ask Diljit and Coldplay, or something like that, right? So, very nicely written note there. But my question is this. What's your view on the Zomatos, PB Fintechs, and this whole tech-enabled sectors, which are probably promising mercurial growth? Will they have higher representation on the benchmark indices, the Nifty and the Sensex too? Could they be multiple times what they are right now in size?
I think those two are easier to answer yes to both of them. Yes, there will be multiple size of that. And will they have a higher representation? Absolutely. However, I would avoid taking a broad brush approach to things called tech. In fact, we as a house do not do that. We don't really cover things like tech. We appreciate that tech at times is just another distribution channel. The cores of many parts of the businesses do not are still there. So we don't really cover it as a tech sector. We cover it based on the core offerings that sector has. So like I think the kind of report that you mentioned would be consumer tech and covered by some of these quick commerce companies and all of that. But the others that you mentioned about is more around fintech, that'll be covered with the finance team. So I would say you need to look at things. There is some amount of tech which is going to be there across most businesses. So we should not really be misusing the word tech. However, there are certain themes where if they are genuinely solving a problem and there is a clear case for them to grow the business and the industry, I think those things are there. I would say quick commerce possibly is one of that spaces where we actually had a very, very nicely detailed report called Abracadabra. So I think that's something which is the other one that you should take a look at. But clearly, there are areas where things are much more promising than the others, and that's where one needs to differentiate. I'm not in the camp. Yes, in a bull market, you try and use a broad brush approach, but that's where eventually survivability and sustainability will be measured. To do that hard work, to appreciate where a more sustainable business model will be, and which is going to continue growing.
Paint them with the same brush for sure. In fact, the last couple of days, Vikas, just stay on, because I want to get in my colleague Harsh for a very quick view on the here and now. We talk with Vikas for the long term, but the here and now, Harsh Johnson to talk about what could be ailing PB Fintech, because we're talking about these businesses, and Harsh, there has been a sharp drawdown the last 2 days on PB Fintech. What could be ailing it?
Now, Niraj, they've spoken about this in their Q1 FY25 con call as well. They've indicated this in the past as well. Now, some of these companies are largely platform entities, right? They are working, of course, in an environment which is traditionally been dominated by physical, but are now platform entities. So PB Fintech, for example, sells insurance. It's an insurance platform, but now what it is essentially trying to do, or rather what Q1 FY25 commentary suggested, was that they are trying to disrupt or trying to capture what will likely be a risk in the next 10 or 20 years, maybe 5, 10, 15 year period. And what's the risk going to be? Insurance policies are, quickly, in terms of sum insured, there is a higher value in terms of sum insured which is being demanded by the consumer, by the customer. They are trying to tie up with both hospitals as well as insurers to understand who will bear this risk, because currently the insurance distributor is earning a good chunk in terms of commission payments. But once the sum insured starts to rise over a period of years, who will bear that risk is essentially seemingly the concern which PB Fintech is trying to grapple with. It's a new problem. It's not their problem either. But what they're trying to do is they're trying to help both the consumer as well as the industry to try and align and figure out as to who will solve this and how will they solve it. And if they do solve it, it will be, of course, a very big solution, because some of these large policies on the low premiums that are being charged may actually have a disproportionate amount of risk on the books of insurance companies as well. So this is a little bit of a twist. They already have a large cash pile on their books, right, and therefore around 5,000 odd crore, and therefore that may also play some part in this new venture that they're trying to get into.
Well, let's see. The opinion jury is still out there. The opinion divided, the voice notes divided. But Harsh, thanks for putting that into perspective. Good to highlight the here and now as well. Want to do a small conversation, Vikash, with you on the one thing that's actually started to move a little now, but had baffled people for such a long time, as to what to do with banks, private sector banks in particular, laid low for such a long time. And sure, I mean, the growth numbers were a bit off, and each of the large 5 private sector banks had idiosyncratic issues too. But do you reckon that the next 12 to 18 months, if the markets have to do well, then banks will be key participants?
See, I think the 12 to 18 months bit is not always easy to guess, because I think they're definitely facing some challenges in the near term. But if you look at a slightly longer term perspective, and many investors who are investing in India are trying to play the long term story, the fact that it could continue for a few more, clearly many more years, it is going to be difficult for banks to not do well if the overall economic growth thesis that we are talking about kind of really plays out. For them to have credit growth closer to what nominal GDP is something which is not difficult to imagine. Yes, there are some near-term worries that have got created. I think for people who have a slightly longer-term horizon, more like a 3-year kind of an horizon, this is one place where there is still possibility of re-rating of multiples. And at times, market has this ability and a willingness to extrapolate the near term. And it could do that at good times, it could do that at bad times. I think for banks, it is happening on the reverse, and that's where the normalization of and that dawning of reality, whenever that happens, could lead to some improvement in the way people look at it. So from a slightly longer term perspective, yes, this is one of the few spaces, very few spaces, where I still see room for a potential re-rating, which could be possible on a slightly more medium-term perspective.
Got it. And would it be restricted to large private banks, or do you believe SOE banks could also feature in that list, Vikash?
I would say the re-rating in the SOE banks has already happened, and that's pretty visible. It is the large private sector banks that I'm particularly referring.
Okay. One last question, Vikash, and again, just broadening out. There's a Bloomberg story which says that buy ratings are vanishing in India's overheated market. Now, I mean, it's a very I won't say hyperbolistic headline, but something which is really pumping up the issue. But my question really is that at your house too, do you sense that the number of stocks on which you can comfortably give a buy call is a lot lower right now than what it was maybe 12 months ago?
Absolutely. I mean, that's something that we've been talking about for the last 2-3 quarters as well. We've seen a couple of quarters where a pretty big chunk of companies, say more companies have seen upgrades as compared to downgrades in terms of estimates, in terms of earnings estimates. Mm-hmm. However, analysts, when they were taking action on price target and recommendation, there were far more downgrade in recommendation than upgrade. I think we are dealing with a unique situation because a few things have changed. We are used to a period where the marginal stock price was determined by FIIs. And those FIIs used to compare valuations in India versus valuations elsewhere. That has fundamentally changed for now. The marginal price is being determined by domestic investors. And these domestic investors, in most cases, have only one market to invest. They do not really compare valuations with what is happening in another market on a regular basis. So I think just the fact that India is more expensive, or it is more expensive versus history, is typically the way analysts look at things. And there could be these short-term periods where that is not a good gauge to give you short-term performance. And perhaps we are in that short-term period where more fundamental analysts, and I myself am one looking at a particular sector, but it is going to be difficult when you look at some of those benchmarks. But, such periods do not last for many, many years. They do last a few months, and they could last a year or two. That is going to be challenging because eventually things, people will follow the money. You can already see foreign companies trying to list into India. So there are things that will happen to kind of normalize this big arbitrage that is existing. So, but in the very short term, this thing can continue for a while. And that's where the challenge comes in, because many analysts would look at history or look at peer base and think that this is not straightforward. And that's where the struggle will continue.
Most certainly. Vikas, great having you. Thanks so much for taking the time out and joining us and giving us your perspective. Maybe if the festive season is too soon, then closer to the year end, or maybe once the new calendar begins, would love to do a conversation. But thanks for joining in today.
Thank you. Thanks for having me.
That's the CLSA view, and that's all the time that we have on this edition of Talking Point. Thanks so much for watching.